money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top three. In amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Faden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell. And here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally 2 people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly, in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. We're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. We need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains,
connection lost.
Modes for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching 1 block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is, is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first 2 people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with 2 normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. 2 normal people getting on a Hyperloop, and then most importantly, those 2 people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic and whenever the vehicle enters, left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects. And the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City. Are we doing this again?
We are.
The countdown to the Fed starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance. The Fed decides.
From New York City, for our audience worldwide, good afternoon to you all. This is a Bloomberg Surveillance special, counting you down to a Fed decision about 28 minutes away. Your equity market is doing a whole lot of nothing. And this market, Lisa, has done a lot more than that over the last couple of months since they last met.
And if you look at specific names, they also are doing a whole lot more than that. I'm looking at PacWest, for example. The banking concerns still are there, regardless of some of the easing and pressures. Just to give you a state of the play right now, we are seeing a 25 basis point rate hike, about 80% priced into the market, and then we're still pricing in rate cuts through the end of the year.
Rate cuts?
Rate cuts,
Rate cuts. Nomura thinks that happens today.
Well, I think that they're very much alone in that.
They're an outlier.
Yeah.
They're an outlier.
I think
there are
that's
some
fair to
banks
say.
out there, Lisa, thinking about a pause today. The game changer in the last couple of weeks, the banking issues. Are we past the point of no return? Marko Klanovic at JP Morgan says we are, that ultimately we have gone past that point. Have we really seen the game changer where things start to break? You're sitting there on the committee and you say, we're done. That's it.
Right now, the market is giving the Fed room to raise rates one more time by 25 basis points. So if they take that, it would make sense, given the fact that they were just 2 weeks ago talking about the concern about some sort of acceleration in inflation. So we shall see. We have really smart people who are going to be talking about this probably more intelligibly than I will. Certainly coming up, we have a former Fed Vice Chair, Rich Clarida. He's going to be walking us through to the Fed decision. Also, TD's Priya Misra will be joining us. That all is up to the 2 p.m. Eastern decision. Then immediate reaction from KPMG's Diane Swank, Bank of America's Michael Gapin, and Morgan Stanley's Matt Hornbach. And then afterwards, as we understand what the market is doing, which usually is wrong, we're going to speak with former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg. I have never before felt like the market's going to be wrong. We don't know how to read the decision. They're in a tough spot. What a mess after a mess of a past couple of weeks.
This is super difficult to approach. Going into it, the market looks a little something like this on the S&P 500, down around about 0.1%. No real drama here. Yields down 6 or 7 basis points, 354.31 on a 10-year. Euro dollar 107.94, positive 0.2%, off the back of a 50 basis point hike from the ECB last week. There's a feeling that maybe that was the playbook for this week. Lisa, what do you think about that?
So a lot of people are saying that, and if you look at the majority, they do think the Fed is going to raise rates by 25 basis points. But that said, it does feel different because the banking issues seem a little bit more systemic in a different way in the U.S.
This is a difficult decision for this Fed today, the hardest in the last 12 months by far. Joining us now to discuss it is Richard Clarida, the Global Economic Advisor at PIMCO and former Vice Chair of the Federal Reserve. Rich, let's start here. How on earth do you expect them to approach this decision today?
Well, I think that they're juggling a lot of competing data and competing motives, but ultimately inflation's too high, and I think they will come down. We'll know in a couple of minutes that they'll come down on the side of doing a 25 basis point hike. I think if they do that, I think it'll be a dovish 25. I think they're going to want to preserve optionality, and almost certainly either in the statement or the press conference discussion will acknowledge the uncertainty and probably the increased tightening of financial conditions. So I think that's where they'll land.
Let's talk through it piece by piece. You've got the decision, but that's only a small part of it, as you've indicated. You've got the statement, the forecast, the news conference. Rich, in the statement, there is this line here about ongoing increases. Do you expect that to disappear in about 25 minutes?
I lean in that direction. I think it will. I think it will certainly. If they want to go in the dovish 25 direction, I think it'll disappear or be modified in some way.
Rich, do you think that that's the likely outcome? We were speaking earlier today with Betsy Duke, a former Fed governor, who said that she thinks the big surprise is going to come with the statement of economic projections, where they increase them in tandem with what they said they were going to do, what it seems like an eternity ago.
Yeah, so much has happened in 3 months. So much has happened in 3 or 4 days. All eyes on the SEP. That being said, Lisa, sometimes Fed chairs, whether or not they be Bernanke, Yellen, or Powell, can distance themselves from an SEP that they're not aligned with. Depending on where the SEP lands today and the message the chair wants to send, we could see that as well. It's very finely balanced. I think only 2 of the 18, remember, Lel Brainerd is now at the White House, only 2 of the 18 dots would need to shift up in order to get the overall median dot to shift up. So I think it is very finely balanced on the projections.
What would you do, Rich, if you were on the Fed? What would you vote for?
I would go for the 25. I think that inflation is too high. I think that it will be challenging to pull off a pause right here. In particular, the whole issue that can come up. We confronted 3 years ago. What do they know that we don't know? So I do think they'll go for the 25. Again, I enjoy doing your show 30 minutes before because we'll find out where we land. Maybe I'll do a post game someday.
Rich, we should do a post game. Stick around. We can do that today. I want to follow up just on the psychology of this. We talked about this in the last couple of weeks. At the Fed, do they really know things we don't know about the financial system? When Chairman Powell sits there in that news conference in just under an hour from now, Rich, does he know things that we don't know about what's happening in the banking system right now?
Well, at some level, sure. The Fed directly regulates and supervises thousands of banks. It has supervisors and examiners, on the ground, as it were. Not all of that goes up, on a daily basis to the chair or to the governors or the vice chair. But sure, part of what the Fed does is it supervises bank holding companies. So it knows a lot about the banking system for sure, an individual bank.
You might need a PhD in psychology to understand some of this, Rich. But I do wonder what the psychology of the decision is today. Do you think they look at this and have an understanding that for some people out there, the more dovish they are, the more worried some other people might be?
Well, that's right, and I do think, Lisa and John, that the reality is that initial conditions matter. If we were several years ago and we not had this overshoot in inflation, I think the Powell or the Yellen or the Bernanke Fed could well pause at a meeting like this. But the history is what it is, which is inflation is too high. The data since the beginning of the year has been too high. And remember, the Fed acted very boldly just days ago to put in place a very appropriate but bold liquidity program, and I think they believe that can address the immediate issues in the banking system, the so-called separation principle. They'd like to use rates to address inflation and use their other tools to address financial stability concerns.
How do they finesse the byproduct of this, which is a $300 billion expansion of their balance sheet?
Well, I don't know if you can, Lisa, finance a $300 billion. The balance sheet is actually now moving, and there are different forces on the balance sheet. You have the facilities which inject liquidity. The Treasury's running down its TGA account. That's adding liquidity. On the other hand, you have this reverse repurchase facility that's draining liquidity. And then you have QT. So there are a lot of moving parts here. I think today will be status quo. I would be surprised if we see an adjustment in those parameters. But over time, if this liquidity provision persists with these new programs, then at some point they will probably have to address it.
Tiffany Wilding of PIMCO came out and said that regardless of whether they go 25 basis points or nothing, this is probably going to be the end of the rate hiking cycle. Do you agree with that? And what is going to be the justification of that if basically we heard from Fed Chair Jay Powell just weeks ago that they were still pretty far away from their goal?
Well, they are far away from their goals. I think it will be data dependent. It sounds trite, but I think in this case it's true. One thing I would say is that whatever you thought about the tightening of financial conditions before SVB and Credit Suisse and the like, clearly we're going to have tighter financial conditions going further. And historically, when bank lending is impacted, as it will be, I think, going forward, that's going to slow the economy, and I think the committee will take that into account. The real question is, when does that start to show up in the data and on their radar screen?
So what do you think he'll say if he's asked today whether the recent instability is disinflationary? Do you think he'll address that straight on, head on?
Jay Powell's a straight shooter. I think he will. I think what he would likely say to a question like that is the Fed monitors broad range of indicators on financial conditions, and I think he would put it in the context of broader financial conditions, probably not wanting to single this out in particular.
Rich, one thing I've said over the last couple of weeks, in fact the last week particularly, and I'll ask this question of you as well, when they discuss the totality of the data, does that include bank stocks now?
Bank stocks, do you mean? Bank equity?
Bank equities, yeah.
Obviously, I'm not in the meeting. I don't know. I think financial conditions come up quite regularly. Whether or not they would hone in on bank stocks, I'm not sure.
Lisa, what do you think about that? The totality of the data. I don't know what it means to be data dependent anymore. It used to be about CPI and what happened with payrolls. What does it mean now after the events of the last 2 weeks?
I think it's definitely the Fed loan survey. That's it, the entirety of it. No, I'm serious. I think it is a shifting target. I don't know that they can really give a good guide to that, because right now they're trying to understand the tightening that they're seeing in the system. Bank stocks won't necessarily indicate that alone, but they're not necessarily totally independent either.
If we get lucky today, Rich Clarida is going to stick with us. Coming up on the programme, we'll be speaking with TD's Priya Misra. Looking forward to that conversation. Around about 18 minutes away from a Fed decision, with your equity market looking something like this, down about 0.1%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The Fed is in just a real big quandary here.
It's between financial stability and fighting inflation.
The desire for monetary and financial stability is at odds with the desire to bring down inflation.
I think their language is going to be very, very important.
Inflation is still running at quite elevated levels.
Yes, inflation is too high.
It is the inflation on the heels of many years of very low rates.
They can't quite stare the inflation bare in the eyes and do nothing.
The market is giving them 25 basis points.
Go to 25, wait and watch
watch what happens.
What we've just seen in terms of banking systems, you don't want to play around with banking crises.
It certainly has given the Fed reason to pause.
If they pause, that could be taken as a negative.
Do they pause? Another question altogether.
The Fed's in a real bind here today.
We can all agree with that. The Fed decision, 15 minutes away, live on Bloomberg TV and on Bloomberg Radio. Here's a taste of flavor of the market right now on the S&P 500, 39.99. If you go back a couple of Wednesdays to March 8th, at the close, 39.92. Why is March 8th important? This is why it's important, because the day after that, this banking mess really started to get going. And Lisa, we are north of where we were back then. We've wiped all those losses out.
Any narrative you want to put to this probably could be contradicted by some other narrative. This is a really difficult one to get your head around, except that people still want to see stocks, see risk assets go up. And there still is around the peripheries, as Alicia Levine said, this feeling that if the Fed doesn't hike as much, that's going to be positive for risk assets.
Let's get to the bond market, 2s, 10s, 30s, and get to that meme stock, that penny stock, that two-year yield over the last couple of weeks. Amazing. 4.14 right now on a 2-year. At the close, the last time the Fed met, first day of February, we closed at 4.1%. We're back there again on a US 2-year, except in between, we've been as high as 5.08% and as low as 360-something on a US 2-year. Lisa, that 2-year yield has been all over the place.
We don't understand the tightening cycle. And Neil Dutta actually wrote in a really good question, which is, how do we have a sense of what model there is to determine what kind of tightening in the banking system we're seeing in terms of how much of a rate hike it's akin to, right? I mean, we don't understand what kind of credit tightening is in the system, and the data is backward looking. So how do you get your handle around where it's fair value?
Super difficult. Let's finish on euro dollar just briefly. Euro dollar at the moment has been trading off President Lagarde and what's been happening with the ECB, which was last week a 50 basis point hike from the European Central Bank. President Lagarde coming out early this morning, basically doubling down, saying it's all about inflation. There's no trade-offs. I think you've heard it a few times over the last few days. Euro dollar at the moment, 107.93, positive 0.2%. Let's get to our next guest, Priya Misra, the head of rate strategy over at TD Securities. Priya, wonderful to catch up with you. Decision 13 minutes away, 25 or pause, when 2 weeks ago it was 50 or 25. What a change.
It has indeed. And I think you've seen the tightening in financial conditions and expected tightening in bank lending standards, but we think the market's 80% priced for 25, that the Fed goes 25. It's all about the communication beyond. But, beyond just looking at sort of the dot plot, we're actually going to be looking at how does the SEP line up with the dot plot. The economic outlook is extremely uncertain. If we get a sense of the Fed reaction function, how would they respond if inflation is a little high but the unemployment rate starts to rise? I think that's what I'll be watching. I think we have to be extremely nimble, but we do think that they are going to hike. They're going to try and separate liquidity facilities from essentially monetary policy. I do hope Chair Powell sells that BTFP program. It's a very generous program. I think talking about sort of removing that stigma, if any stigma exists, I hope Chair Powell's able to say banks access this. It's against treasuries. It's against mortgages. And here, let us focus on inflation.
Priya, Lisa and I just then were talking about Christine Lagarde, the ECB president, earlier on today. No trade-offs between price and financial stability. We will not entertain trade-offs. The ECB has plenty of tools to address financial stability risks. Can you imagine Chairman Powell saying the same thing in around about 42 minutes?
I struggle with that a little bit, because how does monetary policy flow through the economy? It does flow through the banking system, and it does through essentially financial markets. When the banking system is constrained, when financial markets are sort of seizing, freezing, you can use your favorite term, I think then it's very hard to sort of disentangle the two. I mean, I think we have a clear inflation problem. It's not clear how sustained the banking crisis will be. So I think Chair Powell to separate the two entirely, I think would be very risk negative, would make people get nervous that the Fed's going to overdo it. I'm hoping he can use the data dependence, the idea that we've got these tools, but we remain watchful. I'm hoping he can sort of not sound too blasé about financial stability here.
How do you translate financial instability with some sort of equivalency in rate hike?
It's very hard. It's the same thing I struggle with QT as well. These are non-linear effects. Small tightening in financial conditions, I would argue, is what the Fed wants through hikes. When it's disorderly, when it is too much, I think that's when it starts to impact the economy in fairly non-linear fashion. QT is similar. So I actually don't like the comparison because, it would be, it's assuming some sort of linear relationship between tighter financial conditions and rate hikes. It's really when it becomes too much. So very hard to model. I think it's something we're just going to have to track. We're going to have to track things like deposit flows, lending, bank lending, things like that to get a sense of how is this financial crisis sort of feeding through into the real economy.
If Fed Chair Jay Powell comes out, indicates 25 basis points, they're going to hike by that, and there could still be additional rate hikes down the pike. How much does that reprice a market that is pretty much counting on rate cuts before the end of the year?
So I think the 1 year, 2 year part can absolutely reprice because I think we have to understand there's a different threshold for the Fed to stop hiking as there is to start to ease. So I think that zero, the very front end can move. In my mind, the 5 year, the 10 year, that's much more a view of where's the economy. I mean, we were in the hard landing camp even before this. Now I guess we're in a harder landing camp because now you've had that tightening in bank lending standards, or you will have that. So I think the long end might rally, meaning, long end rates might actually fall because if the Fed is not going to have the flexibility to be responsive to the tightening in financial conditions, that's actually going to make things worse for the economy. So I think only the very front end is going to be extremely responsive to a hawkish Fed. The long end is going to, I think, price in a harder line then.
If you are just tuning in live on TV and radio, we're counting you down to a Fed decision about 9 minutes away. Alongside us, Priya Misra of TD. Also, waiting patiently, the former Fed Vice Chair, Richard Clarida. Rich, just to bring you back into the conversation, we were talking about how high the hurdle rate might be, the bar to cutting interest rates. Rich, how high do you think the bar is to cut rates at the Fed?
Well, I think it's higher than it has been in the last 30 years when the Fed was quite responsive when there was any rise in unemployment. And so I do think, obviously, I agree with Priya. I think it's not only something they will do, it's something they should do, is to acknowledge that there will be additional tightening in financial conditions as banks add liquidity. And I think banks, either of their own choice or with the encouragement of supervisors, will be adding more liquidity, which means slower loan growth. But I also think that the Fed message from 10 days ago is still relevant. I think they will be patient. That said, once we do start to see the labor market soften, unemployment to go up as the Fed projects, then we could see a pretty rapid decline in underlying inflation, and I think they would be data dependent and respond to that too. But I do think the bar is higher, Jonathan, than it has been in the past 30 years.
How much damage do you think has been done in the last couple of weeks? And Rich, the reason I ask that, I'm very aware of how quickly things have moved in just 2 weeks. 2 weeks ago, Chairman Powell comes off his second day of testimony on Capitol Hill, opening the door to 50 basis points, and bang, here we are talking about rate cuts and whether they hike or not at all today. And Rich, I'm trying to stay open-minded about the prospect that maybe regulators, authorities come out with a solution for the banking system, and then all of a sudden we're talking about the things we were talking about 2 weeks ago. Is that on the mind of these policymakers? And if it is, what's the prudent course of action for them today?
Well, I do think it's on their mind. I think it should be on their mind. I think the way they'd like to see this go is by providing very ample, as Priya said, very ample and generous liquidity. They think that banks can and should take advantage of that. But I think at the margin, many of the banks that we're talking about are probably going to have to slow their loan growth in order to have a more liquid balance sheet, and that will have to factor into the Fed's projections. Perhaps not at this meeting, but certainly as we go through the year.
Priya, we were talking about how potentially we could see a much higher inflationary regime for a bit longer, and the Fed would have to go further in terms of a terminal rate. Perhaps the further in terms of a terminal rate isn't as much on the table now as it was 2 weeks ago. But do you think that overall growth expectations need to come down because of some greater degree of structural tightening by some of these regional banks?
Absolutely. I think if you look at market pricing, we're not pricing in a hard landing. By the end of next year, after all the cuts that the market's pricing in, we're pricing in Fed funds at 3%. So I would argue that the market's pricing in, an early start to rate cuts, but then some soft landing by the end of next year. If you have to incorporate the lagged effects of monetary tightening, the fact that now we're going to have bank lending tightening, I think you're supposed to price in a decent chance of a recession, which means that the Fed funds rate may have to go well below 3%. I don't know about zero, but perhaps the Fed has to go to 1%, 2%, and that's not priced in, which is why I still like the long end of the Treasury curve, because I think as, the savings buffer of the household sector starts to come down, the household sector, the business sector is going to need loans. And if the banking sector is pushing back, that's not going to happen.
Rich, I'd love you to weigh in on that. Do you agree with Priya there that you could see a Fed funds rate that goes back to 1 or even maybe 2%, but even 1% after all of the discussion around a higher inflationary time?
Well, of course you could. I think there are probabilities involved, and certainly there are scenarios where you end up. I guess I'd like to put on the table a scenario which probably would be a recession scenario according to the MBER, but we could have a rise in the unemployment rate of a point and a quarter, a slowdown in GDP growth with unemployment ending up in the 4s. To me that would be a pretty softish landing, even though it could technically be a recession. So I think there's a wide range of scenarios now, probably wider than we've seen in decades, and I think that's just going to be a fact of life for the foreseeable future.
Rich, one question Tom asks quite often every time we do this, and we miss him today, of course. He's decided to take this week off of all weeks. TK's going to be back with us next week. We do miss him, of course. The more I say it, the more people will believe me, right? We miss it.
Just keep going again and again. All right, let's move on.
No, Rich, I'll get to the question. The question that Tom would often ask is why there isn't any dissent on the committee. Is today the kind of day where you'd expect someone to put their hand up, Rich, and just say, I don't see it this way. We need to pause?
Great question. We'll know in 5 minutes. I don't think so, because I think if there's going to be a dissent, people would telegraph it in their speeches and commentary, and Jay Powell's done a remarkable job of keeping a very diverse committee together. We could well see a dissent, but I don't think it'll be today.
What is the reluctance to dissent on the committee? What's behind that, do you think?
Well, dissents are not, people are not reluctant to dissent, especially Reserve Bank presidents. If you go back, really, you'd have to go back to Volcker years when you actually had governors, and indeed, in some cases, vice chairs dissenting. So for a variety of reasons, maybe we can discuss on a future show, governors are more hesitant to dissent on a monetary policy decision. But Reserve Bank presidents can and do dissent, and during my time there, we had dissents from 3 Reserve Bank presidents on some rate decisions.
Rich, you're absolutely welcome back anytime. I just want to throw that out there, and we can discuss all about governors and the difference. Priya, before we get to the decision, which is in about 2.5 minutes away, any final thoughts on what we should be looking for in terms of the rhetoric, in terms of the statement, in terms of the projections?
So obviously what they're going to do with rate hikes, we're going to be watching that median dot. I would also look at the distribution of those dots. How many are 575 or 6? Is there a hawkish bias to the distribution? And then link that, the dot plot, to the economic forecast. If they lower the unemployment rate and they increase the inflation number, but they keep the median dot unchanged, that's a dovish reaction function. So it's really about communication going forward, trying to understand the reaction function, as we know that the economy is going to look very different, 3 to 6 months from now.
Rich, just one quick one. Do a journalist a favour. What would you ask in that news conference in 32 minutes?
What keeps you up at night?
A lot at the moment.
It's going to be literally everything.
How's your sleep been?
Exactly.
Hey, Richard, thank you. Great to catch up with you, sir. Richard Clowder, Priya Misra on the latest with about 2 minutes to go, Lisa. Let's go through the markets together. Equities at the moment on the S&P 500, unchanged through most of the day. Unchanged right now on the S&P. The Nasdaq positive by 0.4%. The bond market, where the fireworks have been over the last couple of weeks, that's for sure, 4.1237%, Lisa, on a 2-year going into this one. We've chopped it up as follows throughout the whole of this morning. Decision, statement, forecast, presser. 25 or pause is only one small piece, and I'm going to borrow their word, the totality of the decision.
Oh, look at
just
you.
One small piece of the totality of the Fed speak drives me nuts.
I'm just like, seriously?
Absolutely drives me insane. It drives me nuts.
But you're not wrong. I mean, this is going to be one bit of it, and the other one, as Priya was just talking about, is very much going to be what they indicate in terms of the rate hiking path going forward.
So, Lisa, beyond then, the rate hiking path on the dot plot, it was 5.1% in 2023, the previous median dot for 23. We're seeing that move. I spoke to Matt Lazzetti at Deutsche Bank a little bit earlier, and Matt Lazzetti said he sees that holding from where it was in December.
It makes sense, but then do you all of a sudden get people pricing in rate cuts, dramatic rate cuts going forward? And this is really going to be the issue. How do they signal enough of a reprieve to markets without easing financial conditions so much further that it goes against their cause?
That's precisely what a few people have said this week. Can you pause and restart? Goldman says yes. But can you pause today without people pricing in more cuts? That's going to be difficult. 10 seconds away. Mike McKee standing by. Your equity market on the S&P 500 unchanged through most of today. In the bond market, yields lower by 4 basis points. The 2-year 4.12%. Mike McKee.
It's a quarter-point move for the Fed to a range of 4.75 to 5%, and a change in the statement guidance, no longer anticipating ongoing rate increases. Instead, the committee anticipates some additional policy firming may be appropriate. They drop a reference to inflation easing in favor of saying it remains elevated. There is no change in where the firming ends, a median consensus of 5.1% again for the terminal rate, and a slight lean to a hold for longer. The statement does acknowledge the recent bank issues. Quote, the U.S. banking system is sound and resilient, the statement says. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. In terms of the dot plot, 10 members saw 5.1% as a median terminal rate, with 7 above. One put it as high as 5.9%. We do learn Lael Brainerd was one of the lower ones on the dot plot. She had one of the 2 dots below 5.1%, and that's now missing. Next year, the dots see the Fed rate moving down to 4.3%. That's a little higher than the 4.1% in February. 3.1% in 2025 is unchanged from the last projection. The dot forecasts for both years are highly dispersed, meaning there isn't a lot of consensus on what's going to happen after 2023. There is no change, we should mention, in the QT process. The Fed did put out its economic projections. They see growth this year at 0.4%. That's a tick lower than in February. Unemployment is also a tick lower at 4.5%. Inflation's higher. Headline PCE of 3.3% by the end of the year, up 0.2. Core 3.6%, up 0.1. In 2024, slower growth, higher unemployment, and a big drop in inflation to 2.5%. And finally, we should note, the statement was unanimous, guys.
Mike McKee, thanks for that. We'll come back to you in just a moment. Let's work through the price action on the S&P 500, positive by 0.25%. On the NASDAQ, up by about 0.7%. The initial read on this, yields lower at the front end of the curve, just north of 4% at the moment. On a 2-year, 4.01%, down 15 basis points. On a 10-year, down about 9 basis points to 351.85. I'm sure based on that, you can guess on where the euro is. Euro dollar through 108, 108.27, positive 5 or 0.6%. So Lisa, 25, but the median dot, I went straight to that, onto their website, looked at the projection material, 2023, the median dot, 5.1%.
And they removed reference to the ongoing increases in rates, even though they said that perhaps things were going to get a little marginally tighter. So right now, markets are reading this as dovish at a time when they still are hiking rates. And a lot of people were saying they should potentially cut rates. So perhaps because this could be a victory, is that what the Fed wants to see? Is this clear what the Fed wants to see?
I'll say what I often say. This is a 4-part act. So you've got the decision, the statement, the forecast, the news conference still to come. I would suggest that maybe the news conference is the most important act of the whole play, and it starts in about 27 minutes. But so far, in line with what I think a lot of people expected, you move, but then you signal with the dot plot in the SCP that things haven't changed too much. And just compare and contrast where we were 2 weeks ago. We were expecting that 5.1 to come up to 550. 5.1 to 550. That tells you a lot about what they think about the last 2 weeks.
They did indicate that these strains in the financial market does tighten conditions further. Let's see if they can model out, sort of like Torsten Slok, how much that is tightening, right? He says 1.5 percentage point increase in rates. Other people say 0.5% increase. Are they basically coming up with some model, or it's just a feeling? And if it's just a feeling, what are they looking at to get that feeling?
Mike McKee's going to go to that news conference in about 25 minutes' time. I'm hoping Mike McKee is still there. Mike, can you tell me, based on what you've learned so far, what you'd like to ask the chairman in 26 minutes?
Well, there are a number of questions, certainly on supervision and regulation, but I think in terms of monetary policy, it's how much of an impact, as you were just saying, the banking situation is going to have on credit conditions. Is it going to tighten them significantly enough that it does the Fed's work for it, or does the Fed simply feel like they're very close to being restrictive enough to bring down inflation so they don't have to go much higher? They did put a line in the statement about the fact that we're going to see some tightening in financial conditions from the banking situation, but they said the effect is uncertain. So I don't think Jay Powell's going to be able to put a number on it. It's going to be more a question of which way do they lean? Is it the banking situation that causes them to back off from being a little bit more hawkish, or is it the fact that maybe they're making progress? If we hadn't had the bank thing and we got these numbers, they would have said, well, we're getting there.
Mike, just reading between the lines right now, looking at the projections, we're learning something some people think about the reaction function of this Federal Reserve. Neil Dutta of Renmac just said the Fed sees a touch lower unemployment, a bit higher inflation, and left the median dot unchanged for 2023. That is a dovish reaction function. That's hard to disagree with, Mike.
I don't know that I would disagree or agree with it in the sense that they're dealing with a whole bunch of indicators that are backward-looking and some situations where they can't model out or can't figure out what is going to happen. So I think they're more opting for the status quo and saying, based on what we know now, we don't think the situation has changed significantly over the last 2 weeks. We've had ups and downs in the markets, obviously, but this is where we see the economy at the moment going forward. Now, is that a reaction function, or is that kind of we're watching and waiting to see what happens? I don't know that at this point they're becoming preemptive in any way.
Mike, I know I've got to run. Appreciate it as always. Mike McKee breaking down that Fed decision. We got 25. Here's a headline that just crossed the Bloomberg terminal. The Nasdaq 100 has gained 20% from the December low, on pace for a bull market. I mean, Lisa can't keep it together.
Well, this is really the issue, that people were expecting this to underperform even if the Fed cut rates, because we're not going back to a free money era, and any reason for them to cut rates would also negatively impact technology. And yet that has been the playbook, as we were talking with Stuart Kaiser earlier today, and he sees it continuing to be so. What I find interesting, and whether anyone responds to this, is not only do they project that rates will end 2023 at about 5.1%, but they rose the expectation for 2024 to 4.3% from 4.1%. So yes, perhaps they have a lower bar for how high they can go, but they're going to stay higher for longer. The market's not buying this. They're already seeing it well below that by the end of the year. So how do they transmit that message?
So far, so good. I think they've dealt with this in the statement in a pretty elegant way, taking away ongoing increases and replacing it with this line. Some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, without really committing to it, because we don't know. And in fairness to them, no one's got a clue what the last 2 weeks means. You mentioned Neil Dutta of Renmac, who's been asking the question all week. All these estimates out there about what the last 2 weeks mean, how they equate to hiking over the Federal Reserve. It's almost impossible to do, isn't it?
If they don't have a model, though, how do they give some confidence that they have a compass that is reliable and consistent to the market, right? I mean, in other words, what's an important credit tightening and what's not? And this is the problem, is that people aren't sure what data to look at unless it feels like it might be systemic or it feels like it might be concerning. And I think that is the degree of uncertainty that we were just hearing from Rich Clarida isn't going to go away anytime soon.
25 from the Federal Reserve. They hiked by 25 basis points. The equity market a bit firmer on the S&P by 0.5%. A rally on the 2-year. The yield curve steepens just a little bit, or rather we take away some inversion. Lisa, right now the 2-year is down by 12 or 13 basis points. The 10-year is down by 8. So that's been driven by the bull steepener, and we've seen that in a big way in the last couple of weeks.
Well, and if we do get more rate cut expectations baked into the market, because we do see rates ending January at 4.2%, right? So this is a far cry from what the projection is of the Fed. I wonder how that changes through the press conference if they start to say, look, we still have a huge inflationary problem.
Sure.
We still could move higher. We don't view this to be that material, but we are cautious and cognizant of the path that we're on.
Alongside us to weigh in, Diane Swonk, Chief Economist at KPMG, Michael Gapin, Head of US Economics at Bank of America. Diane, first to you, your take on this one. What are your thoughts?
I think that the Fed is basically saying we just don't know how much credit tightening is in the pipeline, and we're willing to do whatever is necessary to chill the economy. We just don't want to send it into a deep freeze, and that's what you're seeing there. I think the idea that, we keep rates higher for longer is important to leave out there, because the Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is. That said, I do think there is quite a bit of tightening in the pipeline that will do the heavy lifting for the Fed, and that's yet to be seen. And I agree, it is not easy to quantify. Believe me, we've been trying to, and it is an unknown, and that's what the Fed is struggling the most with at this moment in time.
Michael, your initial read, and especially this idea that they have to not drop their estimates for rates too quickly, but basically it's just a placeholder in terms of higher rates for longer.
That's right. I have a similar read. The dot plot tells you and the statement tells you they do think that they're going to get some additional policy rate tightening out of recent events. How much, they don't know. How much will depend on how successful they are at ring fencing and limiting spread from the current situation. If they're successful, the committee is telling you they have one, maybe two more hikes to go. If they're not successful, obviously we'll take that day by day and week by week. So I have a similar read on this. They're going to try and use their tools to separate financial stability and price stability at the moment. Doing that entails a lot of uncertainty.
When we talked about financial stability over the past year, it was talking about equity valuations and bond valuations, and we were concerned about whether financial conditions were too easy and easing further. Diane, is that no longer a concern as we see basically an easing implied into markets if you only looked at stocks going up and bond yields going down?
It really isn't the way to look at it right now. I think the important issue is what's going on in the broader financial markets, not just in the U.S., but abroad as well. We've seen some fragilities in international financial markets. We saw the IMF move on the Sri Lanka bailout and talking much more aggressively about the Pakistan bailout. These are all reflections of fragilities that have been revealed in the last 2 weeks, at the same time that we know at home that we're going to see a tightening of banking conditions, a tightening of credit market conditions that are likely to hit the backbone of employment gains, and that's employment gains in firms with less than 250 employees. Those have driven employment gains and offset layoffs elsewhere, high-profile layoffs in the U.S. economy. That's an important thing to keep in mind, is where you're going to see the credit market tightening and how it affects the economy and how it plays out. It's really going to hit very hard the part of the economy that's held it up and kept it so resilient for so long, and kept demand so resilient, which has helped to buoy the inflation numbers as well.
Just to work through some of the statement, guys, and to come back to you, Mike, there is this line in there about additional policy firming may be appropriate. They've dealt with this in a quite elegant way, I think, getting rid of that ongoing increases line and putting that in. It's vague enough for it to mean whatever you want it to mean, I guess. Francis Donald is asking that question, though, over at Manulife. What the heck is policy firming exactly? What are we talking, QT or rate hikes? Mike, how are you interpreting that extra line?
I would interpret that as, the way that I look at the SEPs, the forecast there will assume that they're successful at corralling financial stresses, right? That this is the board saying, what do we think is the modal outlook? The modal outlook, we think we're going to be successful at doing what we need to do. And in that world, additional policy rate firming is one or two more rate hikes. That's the way that I would interpret it. But that's a modal forecast. It doesn't take into account distributions or uncertainty. There's a lot more of that right now. And so I do expect a lot of the message in about 20 minutes to be, well, we'll see. It's gonna depend on how things evolve.
Well, let's talk about how the chairman handles the messaging in the news conference. They can control this, Diane. They can sit there for 48 hours, work out the wording of the statement, look at their projections together, think about what that signals. How do you think the chairman manages the message in 15, 18 minutes' time?
This is really the hard part. We know that the volatility during the press conference is the most volatile time for financial markets, and that financial markets can often get a different message. We saw coming off the last meeting, the statement itself was very hawkish, but the messaging and the tenor of the chairman actually sounded a lot more dovish, and financial markets rallied. He then hit the reset button when he did congressional testimony on March 7th and 8th, and I think he's going to be very careful to talk about his confidence in the broader financial system system, but that they are very aware of the tightening that's in the pipeline. And walking that high wire act right now is going to be his job. He's cannot afford to take a misstep. He's got to be very careful to not signal to financial markets that things are worse than anyone thinks, but also to acknowledge that they know there is some tightening in the pipeline that they may have to adjust to.
Michael, what would your question be to the chair?
Two things. Why did you declare a systemic event? Preemptive, or did you actually see something that rose to the level? And second, does a larger balance sheet through the provision of liquidity through these facilities offset what you're doing on quantitative tightening, or do you see these two things as different?
What do you think in terms of the balance sheet question, Michael?
I think they're different. I think liquidity provided through these emergency lending facilities is not the same as letting securities roll off your balance sheet. So I don't think what they've done is offsetting what they're doing on quantitative tightening. That's my view. I'd like to hear what he thinks.
Mike, I know you were on the fence about calling that hike, but you got it. You got it. Mike Gaithan, we've got to let you go. I know you've got to run. Mike Gaithan there of Bank of America. Thank you, Mike. Thank you as always. I think a lot of people were on the fence going into this decision, 25 or nothing. I just can't believe, Lisa, how quickly this conversation has changed in 2 weeks. We've gone from Chairman Powell in his semi-annual testimony teeing up, at least opening the door to 50. The data, the follow-through, let's be clear, the follow-through on the economic data backed it up.
Right.
Backed it up. Payrolls was decent, CPI, and now we're sitting here and saying, yeah, no.
It's better to be lucky than right. We keep saying that. And how much they luck out with their 25 basis point decision to downshift to 25 basis points. And now it looks genius, right? Because they could just hike by 25 basis points and seem like they're on track. I thought this was really interesting, a Deutsche Bank survey of market analysts. And they said that 86% of respondents said that the Fed will go 25 basis points. Only 53% said they should. Everyone was on the fence between nothing, possibly a 50 basis point rate hike, a 25 basis point rate cut. So here we are.
I see two camps right now. There's a group of individuals that are extrapolating out the events of the last 2 weeks, saying we've passed the point of no return. Tighter lending standards are coming. The Fed is done. Like, that's it for the year. There's another group of people who are trying to stay open-minded about the whole situation, saying it's only 2 weeks. It's a process. I have no idea where we are in that process. And do we face the real risk that the Fed could be going again? If things can change this quickly in 2 weeks, where are we a week from now? 2 weeks from now? I don't know. I don't think the committee knows either. And that's the challenge for this news conference for the chairman.
And I think that the gap between what people think that they should do and what they will do highlights that people are going to try to blame the Fed no matter what. So it's always going to be, some kind of finger pointing. But right now, the market seems to be handling this very well. And I think that seems pretty clear.
The equity move fading a little bit. We're still positive on the S&P by a 1/10 of 1%, on the Nasdaq up by about a 1/2 of 1%. If you check out the bond market, that move sticks, down 10, 11 basis points at the front end on a 2-year. Right now, 4.058% on a 10-year, down 8 or 9 basis points at 352. Dollar weakness, euro strength. Euro's been gaining now for the best part of a week. Euro dollar 108.43, positive by about 0.7 of 1%. Dan Swong's still with us. With us as well now is Matt Hornback, Global Head of Macro Strategy at Morgan Stanley. Matt, you've had about 16, 17 minutes to digest it. What stands out for you?
Well, John, thanks for having me on, and yeah, thanks for giving me some time to digest this. I think when I look at the message from the Fed via the SEP and their decision to hike rates, what strikes me is how they have balanced financial stability concerns against concerns about stickier inflation. And the way they've done it is they've told us they're going to hike less, but cut later. Hike less, cut later. That's the way they've decided to balance these two concerns. And that seems like a pretty rational decision. So I think the market should feel comfortable with this. The bond market, of course, is now going to have a very difficult time taking out these rate cuts that are priced in through the balance of this year. I would not expect the market to take those rate cuts out in the near term, and it could very well price in more cuts if the data deteriorate from here.
Well, Matt, let's talk about that. We're data dependent. I hear it all the time. At the start of the year, what happened was exactly what we're talking about. This spread between what the Fed was signaling and what the market was pricing. Market was saying rate cuts, recession's coming. Then the data just pushed the market to reprice, encouraged by the communication from the Federal Reserve. Given what's developed in the last couple of weeks, it's a new risk. It's financial instability. Matt, with that in mind, how sensitive will we be to traditional indicators, CPI, payrolls, when it comes to revising those rate cuts?
Yeah, I mean, I think that investors are going to discount data that looks fine and overweight data that doesn't look fine. And so, ultimately, if you have not an unemployment claims number that prints 200,000, pretty much in line with the recent trends, people will, think, what, that just hasn't felt the impact of what's going to come. Versus if unemployment claims surprises to the upside by 50,000, all of a sudden investors are likely to read that as recession is at our doorstep. So, that will be the bias of how I think people see data for the next couple of months.
And there's also this question of the terminal rate and where it ends up. The fact that it doesn't come down as quickly as people previously thought, Diane, raises this issue of whether the market is wrong in thinking that the last 2 weeks created an environment for even tighter financial conditions that would drag down growth the way that Priya Misra and Rich Clarida seem to be thinking much more than people thought, as well as where the Fed can cut rates to eventually.
Well, I do think that it is an issue. I think the Fed does risk at this point in time, even though all the data to date has been hot and strong, we also know all the seasonal factors that have contributed to that are going to reverse at some point in time as we get into spring. We've got another hot PCE number coming out that the Fed is staring down, and so they don't want to look weak in front of that. That said, I do agree that we're going to see some weakening, and we're actually going to see, like I'm worried about, that the employment situation is going to deteriorate, not a cliff event like we saw in 2008, but a slow erosion. And that's what the Fed is starting to look at, is they're sort of looking at eroding inflation slowly. I think that's a very nice way of thinking about it. It's not clear that that's exactly how it works in reality. We're now talking about a much more of a straw that breaks the camel's back kind of moment that we could see out there, not a cliff event, but a much deeper recession than the Fed would actually desire. And I think that's the challenge for the Fed, is how does it sort of say that it's allowing for that tightening of financial conditions, but also in allowing for it, is it going to be too much now on the other side of it? And we want to cool the economy. The Fed's goal is not to send the economy into a deep freeze.
Listening to Diane speak, it feels like the balance of risks has shifted. Matt, I'd love you to weigh in on how the balance of risks has shifted, how significantly, and how that could be reflected today.
Well, I
think the balance of risk. Go ahead. Sorry, go ahead.
Matt, go ahead.
Yeah, so I mean, the way I see the balance of risk, they've clearly shifted to a weaker outlook for the economy. I think the Fed has acknowledged that in not so many words, but the press conference will be an opportunity for Powell to give us a different spin. But nevertheless, I think the balance of risks have shifted to the downside, and the market pricing is reflecting that. We are back to pricing 60, 70 basis points of rate cuts by the end of the year, and that, I think, tells you everything you need to know about the balance of risk this year.
Let's work through this decision. If you're just tuning in, welcome to the program. We are about 8 minutes away from a news conference with Chairman Powell. This is the Fed Decides, Bloomberg Savannah special, live on TV and radio with Lisa Abramowitz. I'm Jonathan Ferro. Here's your decision. It was consensus at 25. We looked for a hike. We've got one. Some people thought we'd get a pause. We didn't get that. The language in the statement was always going to be important. The language of the previous statement read something like this. The committee anticipates that ongoing increases in the target range will be appropriate. That's gone. It's been replaced with this. The committee anticipates that some additional policy firming may be appropriate, and you can take that to mean whatever you want it to mean right now. We have to look at the forecast as well. Lots of moving parts here, but I'll pick out one for you. There is the so-called median dot, year-end for 2023. At the previous meeting, or rather the previous set of projections, suggested 5.1% would be the median dot for year-end 23. That stays the same. So here's the price action in response to that. The S&P 500 positive by about 0.2%. The gains fade just a little bit. In the bond market, yields are lower at the front end of the curve, down 12 basis points. Your 2-year at the moment, just north of 4%. I know we need to frame where we've been the last month or so. So north of 5%, south of 4%, somewhere in between the high of the last month and the low of the last month. 360, I think, the low. Lisa, 368-ish. The high, 5.08%.
This goes to this idea of the Fed's going to hike until something breaks. And there was this idea in the market over the past couple of weeks that something was breaking and indeed had broken. And suddenly people thought, okay, rate hike's over, start cutting. And now perhaps we found some stability. So where does that leave the inflation picture John, the striking aspect of this is that people seem to be downgrading their longer-term view of inflation and how high the Fed's funds rate will ultimately show up. I want to hear about that from Chair Powell, his understanding, what they're looking for to determine what that terminal rate looks like.
This is a financial stability shock, and people have been reflecting on the experience of the UK back in September, October time, and we discussed this earlier this morning. The difference is the underlying policy risk back in the UK was inflationary. It was fiscal authorities willing to spend a whole lot more, cut interest rates, do all of those things. It was an inflationary risk that really upset financial stability. Here, you'd have to argue the consequences of the financial instability of the last 2 weeks are disinflationary. That's a major, major difference for this committee. So I go back to a question I asked Rich Clarida. If Chairman Powell is asked in 6 minutes if he thinks the financial instability of the last 2 weeks is disinflationary or not, that's something I've got to answer. And clearly, I can't tell you the magnitude. I can't put a number on it. But I think we can coalesce around the idea of what direction it's heading in. I think we can do that.
And he flicked at that, right? I mean, he basically said that this does de facto have a tightening kind of effect on financial conditions. They can't put a finger on it. So then what are they looking for in terms of the holistic data? Is it bank stocks or is it something else? Is it a lending survey? And that, I think, will be an interesting question. If we're not looking at JOLTS anymore, what exactly are we looking at?
Bank stocks. I joke about it. The totality of the data has to involve what's happening with banks. Sure. And that's what's driven, or at least revised, the perception of pretty much everything when it involves this Federal Reserve. Just to finish on euro dollar, 108.50, positive by 0.75%. So that's a stronger euro, a weaker dollar. With us still, Diane Swanker, KPMG, Matt Hornback, and Morgan Stanley. Diane, history. We're always talking about history in this Fed chair, not wanting to be Burns, wanting to be Volcker. I wonder what history will look like when it comes to this decision today. Whether his biggest risk in this news conference is being Burns or being Trichet and hiking into a much bigger mess.
Well, that certainly is a risk out there. I think what the chairman is going to do is say how many options they have on the table and how closely they're watching everything, including the Treasury market. We saw the short selling that pushed the Treasury market liquidity way down to March 2020 levels in the wake of recent events, and I think that's very important as well. Also, they're watching their own deposit window. They're watching bank deposits and the deposits at banks, and what does that mean for liquidity in the broader banking system? They're also looking at the international situation. They've always said they're looking at all of these things at once. Looking at all of them at once has taken on a new sort of spectrum for them, and the risks are now much more to the downside. That this is, I agree with you wholeheartedly, a much more disinflationary story off of an inflationary and a sticky inflationary scenario. Going into 2 weeks ago, we had all the data and got even more affirmation that it looked like inflation was getting sticky, and they're going to get another hot number on the PCE index at the end of the month. And I think that's important to keep in mind as well. But all of that is backward looking. When you look forward, you've got to be worried about what you see. And I don't think the horizon is very clear at the moment. It's why I actually think that we saw so many people say, well, maybe they should pause, or maybe they would pause. Almost 50% of your survey people said, well, maybe they will pause, even though we think they're going to go quarter point. And I think that's because of the uncertainty we face right now. And it's really important for the Fed chairman to underscore that he's confident that the inflation will come down. He said that he's willing to take higher unemployment. As Rich put it, well, a 1% increase in the unemployment rate would make it a recession, a very mild recession. What he has to worry about now is a much more uncontrolled rise in unemployment.
Matt, have we just downgraded the economic data as backward-looking and less relevant after basically emphasizing that entirely?
Well, I don't know if we've downgraded the backward-looking data. I think we've upgraded the current data and the forward-looking data. And by that, I mean what we really need to be paying attention to is what's going on in the banking system. We need to be paying attention to what's happening with money market funds. You know, just yesterday we had over $50 billion inflow into money market funds. There's money that's starting to come out of prime money market funds. You know, it's on the low side right now, but that is a concerning trend that we're starting to see. So we need to be paying attention to the flow of funds data that we get in some cases in real time and in other cases with a week or two delay. But that's the data that's most important at this point in time.
Hey, to the two of you, just brilliant, as always. Matt Horn back there of Morgan Stanley, Diane Swank there of KPMG. Thank you very much for being with us. If you want to find some dissent on the committee, there's no official dissent, but you can always look at the range of estimates in the summary of economic projections. Do you want the range for Fed funds in 2024?
It's pretty significant. Oh my goodness.
3.9% to 5.1%. Previously in December, it was 3.9 to 4.9. So there is someone there that has said, since the last meeting, I think that needs to go higher.
How about the 2025 projections? There's one person that says 5.5% and one person that says 2.5%. So if you look at the spread and how wide it's gotten, you have this sense of just how significant the uncertainty is among Fed officials.
It's kind of nuts, isn't it?
Yeah.
Just looking at the range, the central tendency and the median, they really start to tell you different stories.
Especially because longer term, we don't know what the destination is, even Fed officials. And that, to me, is one of the biggest questions. Can we re-rate our longer term expectations after so many people said we are in a new, secular, more inflationary environment? Does that change somehow if you have banking failures and if you have restricted lending at some of the big regional banks? I don't know the answer to this.
Well, quite clearly the story's changed for this market 2 weeks ago. I keep saying this, in the last month we had people coming on this program saying there was a secular component to the inflation story. It's high for like ever, forever. They're never going back to where we were. And now people are reconsidering their whole story, their whole framework for this market based on the events of 2 weeks, Lisa.
Priya's saying that she could see the Fed going back to 1% in terms of a Fed funds rate. It's not zero, but it's pretty much pretty close compared to where some people were projecting it out not that long ago.
That goes against the grain.
Yeah.
The idea we go back to 1. Rich Clarida, the former Fed vice chair, was on this program about 40 minutes ago. We asked him how high is the bar to cut rates, and he said the bar is pretty high to cut interest rates for this Federal Reserve.
Yeah, you start getting a couple banking failures, does that bar get a little lower? I mean, that's what I think people are saying in the markets, and certainly you are getting a very measured response. Let's see if the news conference can give us a bit more clarity without disrupting anything that seems to be orchestrated very well right now.
Chairman Powell walking into the room after hiking interest rates 25 basis points is the chairman of the Federal Reserve.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick?
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the
I was curious, why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clearly we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Go to Mike McKee.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome that. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Katerina.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently engaged, very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that. If the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. You know, the models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's what so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, you know, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, you know, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean?
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
Do you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review is going on, and you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So, policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
Thank you.
Thank you very much.
That's all I have to say. That's one way of wrapping up a news conference with Chairman Powell down in Washington, D.C., live from New York City. Good afternoon to you all. This is Bloomberg Surveillance, live on TV and radio, alongside Lisa Abramowitz. I'm Jonathan Ferro, picking up from the news conference after Chairman Powell and the committee hiked interest rates by 25 basis points, a rate hike, but they considered a pause, and he was keen to communicate they don't see rate cuts this year as well. Here's the price action for you on the S&P 500, down about 0.5%. It was higher about 30 minutes or so ago. We turned lower. Likewise with the NASDAQ, we're now down about 0.1% also. In the bond market, though, this move sticks. The two-year yield down by 20 basis points, 397. Let's call it. Let's round that up for you. On a 10-year, we're down about 12 basis points to, let's call it 350, just about sub 350 at 348.66. Taking a look at the euro against the dollar, euro-dollar, looks like this, 108.76, positive about 1%. That is a stronger euro. That is a weaker dollar. Lisa, what's really interesting about this meeting is that at the same time Chairman Powell was speaking, the Treasury Secretary was as well. And arguably in the last hour, you could make the argument that the most important headline came from the Treasury Secretary and not the Fed Chair.
100%. Fed Chair Jay Powell was boring. I mean, let's be honest. That was a boring press conference. He didn't really say anything other than we're not sure. We adjusted our projections and really towed the line. But Janet Yellen said she is not considering a broad increase in deposit insurance despite all of the discussions around some sort of blanket deposit insurance. This is spooking the market, and you can see that immediate response in markets. So at what point is this counter-programming? Jerome Powell comes out and he's saying everything's fine. We have complete confidence in the stability of financial system. And she's here kind of raising questions about what the backstop is going to be for some of these regional banks.
So we asked the question through the last hour, in fact, the last couple of days. Can you take the financial instability of the last 2 weeks and work out how it equates to interest rates at the Federal Reserve? That's clearly something the Fed Chair and the committee are trying to do. Take a listen to what the Fed Chair had to say.
For purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions.
This underpins a massive difference between the communication from this Fed Chair today and what you've heard from President Lagarde in the last week. The experiences in this banking system in America right now, very different to the experience in Europe. There is a real belief on the committee at the Federal Reserve, communicated by the Fed Chair, that they believe, like many people do, have spoken to us in the last couple of weeks, that the financial instability will lead to tighter credit conditions, and that could be a substitute for the tightening through rate hikes that this Fed could deliver.
He specified it's hard to know exactly how much, and he couldn't come up with a model like some others have come up with to try to pin that down. But they're trying to game it out anyway. I mean, you were noting that. And basically, there has been a marked shift in the expectations. Again, a lot of this, it really hinges on the stability of the financial system. And so I do wonder, why, A, he didn't really discuss deposit insurance and how important that was to the banking system, especially as B, Janet Yellen went out there and was like, yeah, no, that's not really going to happen.
Do you think that's clearly because he wanted Treasury Secretary Janet Yellen to take care of this herself? Knew that she was speaking at the same time?
You know, I'm not going to speculate. I mean, I can speculate, but it's not really going to help. It's not going to help anyone. I'm just wondering what the communication here is in terms of policy, especially because you need the political will to do something like that at a time when it's unclear that they can get really much done. I mean, we're still talking about not getting a budget passed. So, I mean, I just wonder how that's going to be the fly in the ointment for this whole messaging procedure at a time when he was successful. It was boring. He didn't really make any waves, and that is an absolute rip-roaring hallelujah.
Oh, that's a big achievement, considering how tense, how difficult this moment was for this Federal Reserve. If you are just tuning in, welcome to the program. A 25 basis point hike from the Federal Reserve. We had a statement, we had some projections, we've just had a 40-minute news conference or something like that. In the statement, they'd previously said at the last couple of meetings that the committee anticipates ongoing increases in the Fed funds rate. That's been replaced now. The committee anticipates that some additional policy firming may be appropriate. He was asked about what that means, policy firming. He said the important words here, Lisa, are some and may. Some and may. That there might be some, and it may happen. I guess you can read into that whatever you want to read into that. Ultimately, they're trying to stay open-minded about the whole thing.
Ultimately, they're saying, we have no clue. I mean, look at the projections that are all over the place going out to 2024 and 2025 when you look at the dots. They're saying, we don't know. We're watching things the way that you're watching things, and we're not going to rock the boat, but we still do see inflation being an issue. Basically, they've been listening to all of our commentators and representing all of their views in a perfect way to not rock the boat. My question is just, are we going to step away from this saying Janet Yellen kind of did it for him?
Should we work through the projection materials? For 2023, the median dot is 5.1%. The previous set of projections, which I believe was back in December, also 5.1%, so no real change there. But Lisa and I were looking at the central tendency and the range of estimates on the committee as well. The range of estimates on the committee for 2023, Lisa, anywhere from 4.9 to 5.9. For 24, I think you picked up on the longer dots as well, 3.4 to 5.6. I mean, we don't get real dissent at the Federal Reserve. It's rare that you hear from anyone. It's often the regional Fed presidents when you do get some, if not always. But you can see, based on the projections and the ranges there, that there is a pretty wide range of views about where they think rates are going.
Okay, get this. I can't get over this. 2025, someone has their dot at 5.6%, and someone else has their dot at 2.37%. So try to square that. I mean, basically, you have a 2.5 to 3 percentage point gap between those two. We don't understand where we're heading. I just wonder whether they're going to really be guiding or whether they're going to be following the market. And the market gave them an opening and they took it.
Just an extra line on financial stability and what the Fed chair had to say in the news conference. Do you remember that line from Senator Warren in the last couple of days? Was it on Face the Nation on Sunday, where she said, this chairman, he said all he wants is looser financial regulation. He said, I plan to support stronger supervision and regulation. Have we put that to bed now? That ultimately that's the direction of travel, that's what the Fed's going to be pushing for?
He never came out and said, all I want is looser financial conditions and less regulation. That's not probably an accurate depiction of what he said. There still are questions emerging. When they knew, what they knew, how quickly they're sort of keyed off when there is some sort of risk. There still are questions. He's just going to point to the investigation. But, you know, people are still looking for a lot of answers.
Up front at the top of the news conference, we're prepared to use all tools to keep the bank system safe. Went on to say there's ample liquidity, it's available, and that depositors' savings are safe as well. Now, that one's interesting. To what degree? To what extent? To what amount? We know the FDIC limit, 250,000. We thought maybe that's going to get changed. Inevitable. We were just trying to work out what the number might be. The Treasury Secretary's comments in the last hour may be muddying the water a little bit.
A little bit. I mean, this was one of the proposals on the table was some sort of broad increase in deposit insurance. She's saying, we're not considering a broad increase in deposit insurance. How much are their hands tied? When you look at Senator Schumer as well as Kevin McCarthy, both sides of the aisle, not really having much political will to have anything that could be skewed as a bailout in some of the political propaganda. I mean, that's really the concern. And anything that they do could be skewed as that. So there's not really the emphasis on doing something that, you know, perhaps some of these officials would like to see.
Let's get down to D.C. and catch up with AMH. Anne-Marie, your latest read on the latest comments from the Treasury Secretary.
well, it goes against some of our reporting, but we should note that it is within the Treasury Department's purview to do the due diligence, to look at potentially if they were have to do this again, to expand the FDIC, something that obviously we know mid-sized banks are asking for. But Janet Yellen, the Treasury Secretary, didn't mince words. She said that at this moment, not something that we have looked at. So potentially it hasn't gotten to her desk, or potentially it's not in a place where they'd be making a decision on it, but our reporting is that the Treasury Department was doing this due diligence, not something to invoke risk, but just something that they wanted to make sure they could have the research and intelligence done if they were have to take that step.
Anne-Marie, thanks for that. Down in Washington on the latest, two things happening at the same time. We've been following the chairman's news conference down in Washington as well. Mike McKee's been inside that news conference. Mike, let's talk about it. Great exchange with you and the Fed chair about 30 minutes ago. What was your takeaway?
Well, I think there are a couple takeaways from this. One is that the Fed is, leave the banking system aside, still concerned about inflation, still worried that they are not tight enough, and prepared to go higher with the Fed funds rate to bring inflation down. And he reiterated that they're going to leave rates at the higher level until they get some progress on inflation. So the banking situation doesn't seem to have affected the course of monetary policy. The interesting thing on the banks, though, is that Powell was ready to say that Silicon Valley Bank was very badly managed, they did the wrong things, and that while there's an investigation into what the Fed did wrong, this was basically a couple of bad banks as opposed to a systemic problem. I'm not sure that message is going to get received as he specifically tried to get it out there, but he was trying to reassure people. As far as the FDIC limits and the bank deposit limits, Congress has to approve that, and it really doesn't have anything to do with the Fed. The Fed can do can vote for an emergency exception, as they did with these two banks, but Treasury has to agree and the FDIC has to agree. It's really a Treasury FDIC proposal that then has to go through Congress. So I think what Powell was trying to do was reassure Americans that their deposits are safe, because nobody's going to really let them lose a lot of money, but he can't make any promises because it's not his business, it's not his job.
And we are seeing some of those bank stocks fall further after the comments from Janet Yellen, despite some of the assurances from Fed Chair Jay Powell. Mike, Steve Chivarone wrote in saying, I'm wrong, it's not a boring meeting. It was actually really interesting. He said, I think this meeting marks the passing of the torch from inflation and duration risks to recession and credit risks. Did you take that away, too, that the tone had shifted in terms of the greater likelihood of a hard landing and the greater likelihood of some sort of credit event?
If there was a shift, I think it was more towards uncertainty. I don't think it was anything to do with recession or pullback. The Fed still thinks inflation is the biggest issue, and the Fed still wants to stay on its policy path. There's a little bit more of a willingness to say, if things go south, we would be willing to look at monetary policy actions. But several times he repeated, rate cuts are not in the cards right now. They're going to have to wait and see. They don't know what the bank problems are going to mean in terms of credit tightening, but some of that credit tightening from the banks may be exactly what they're looking for, so they don't have to raise rates as high. But no, I don't think the Fed at this point has switched gears at all, acknowledging more uncertainty, but not suggesting they're anywhere near a hard landing, or that they're anywhere near closer to knowing how the landing is going to come about.
Hey, Mike, wonderful work as always. Mike McKee, just one of the best. My terminal always lights up when Mike asks the question in a news conference, always. Great question. Mike nails it. If you missed it, here's Mike nailing it in the news conference.
Participants don't see rate cuts this year. They just don't.
Are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
For purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes.
Joining us now to discuss, Bill Dudley, former New York Fed president, and currently, of course, Bloomberg opinion columnist. Bill, you've had some time to process all of that. What do you make of it?
I think it was pretty logical what happened. Basically, the Fed is saying that one, uncertainty has gone up a lot. We're not really sure how long the banking system stress is going to last and how severe it's going to be. Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier. But I think the real key is something that Mike McKee talked about. Uncertainty has gone up. Uncertainty has gone up a lot. And I think it's sort of interesting that markets are not really fully focused on that, because the risk of a hard landing is higher now, because the Fed isn't going to really know what's the appropriate policy to do until they get a lot more information. And it's going to take time for that information to be received. And it's not going to be very easy to assess how are these banking woes going to affect credit conditions, and how much is that going to affect economic growth. So I think that we're actually in a worse place today than we were a few weeks ago, because there's just, there's two forces. One force is keeping inflation high, the other force is slowing the economy down, and we don't know which one is going to dominate or for how long. So I think the risk of a hard landing has definitely gone up.
Bill, the easy way to dismiss any conversation around the Fed is just to say they're data dependent. I hear that so much. They're going to be data dependent. But Bill, at this point, I'm wondering, what data are they dependent on for the next decision?
Well, I think the problem is that the data on the effects of credit tightening on the economy take a while to actually be realized. We have two sort of open questions about the banking system. Number one, how broad is it going to be? How many banks are going to be affected? Number two, how much are banks that are affected actually going to tighten their credit standards? The problem is not a credit problem. The problem was they actually banks taking on too much interest rate risk. So it's not obvious to me that tightening credit standards is really the logical response. And number three, how long is this going to go on? So I think that there's a lot of uncertainty here about how much of a braking effect the banking system woes are going to be on the economy. The fact that the Fed basically has one more rate hike and then keeps rates high throughout the year suggests that at this point, they don't think that this is going to exert a lot of downward momentum on the economy. What's interesting today is the market reaction to the Fed's press conference and the statement and the summary of economic projections was to be ever so slightly surprised by the rate hike, because it wasn't fully priced in. But actually, it's pricing in more rate reduction in the rest of 2023 and into 24 than they were earlier. And I think that was a little bit surprising, frankly, given the fact that Powell was very clear. We don't expect to cut rates in 2023.
Does that open up a question about the credibility of the Fed?
I think it opens up a question that people are just very uncertain about what the banking system will mean for economic activity, and then how does that actually translate to the Fed. I think people are worried about the downside risk from the banking sector.
Steve Chivarone, Federated, I keep going back to this because I think it's a really salient point. This meeting marks the passing of the torch from inflation and duration risks, he wrote, to recession and credit risks. Arguably, what we have seen is not a credit crunch. However, often liquidity crunches can lead to credit crunches, as we've seen in the past. Bill, do you agree that this really is a tipping point as represented to some of the changes in the statement?
I think it really depends on how broad and how long. I mean, we've had other examples where there have been all sorts of market turbulence and no recession resulted. The most obvious example of that was the 1987 stock market crash, where people were talking about making analogies back to the Great Depression, and the economy didn't go into recession at all. So I think the real issue here is how many banks are affected and how strongly do they react. When I look at the U.S. banking system today, I see only a handful of banks that have actually been affected, and they only account for a few percentage points of total banking assets. So I personally think that if this thing is stabilized right here, the effects on the real economy are going to be pretty modest.
So to be clear then, Bill, that's an important point, because we're only 2 weeks into this. If it doesn't spill over and carry on bleeding, are we going to go back to what we were talking about 2-3 weeks ago in another 2 weeks?
We very well can. I mean, I don't think we'll have the clarity in 2 weeks, but 6 weeks from now, the next FOMC meeting, maybe we're back in the situation where, the banks that were under pressure have either remedied themselves or been acquired, and the rest of the banking system is fine, and the economy is still too strong, and the labor market is still too tight, and inflation is still too high. I mean, the reality is the Fed actually hasn't accomplished much yet in terms of generating more slack in the labor market or actually bringing services inflation down. And that's important to recognize.
So when the Fed chair says we're not thinking about cutting interest rates this year, I guess you're saying we should really take him seriously, because you don't think that's going to happen at all.
Well, there's a lot of, there's a wide band around that possible outcome. But I think what he's saying is that job number one for the Fed is to get inflation down to 2%. And they think that's going to be a long, drawn-out process, not something that's going to happen very, very quickly. I thought it was interesting in the summary of economic projections, if you look at their forecast, the forecast virtually unchanged from the December meeting. So essentially what they did was, economy is stronger than we thought, inflation is higher than we thought. Oh, but we have had some banking system woes. What should we do to our forecast? Well, let's leave it basically unchanged. Because that's and they're doing that because they just don't know which of those two forces predominates.
John mentioned that you could drive a truck through some of the economic projections if you take a look at the dots and how far apart the highest and the lowest are. I was really struck by 2025 dots and just the range of estimates from 5.6% to 2.5%. I'm wondering if you've ever seen anything like this before, where there is so little of a compass directing all Fed members, but even if they're on the same page right now.
I think that they're on the same page in terms of if you told them what the economic forecast was, they would write down interest rate paths that was pretty similar. I think what they probably disagree on is how is the economy actually going to evolve? How quickly is inflation going to come down? What's going to happen to economic growth? Are we going to have a hard landing or a soft landing? And so there's probably just a lot of uncertainty about how the actual economy is going to evolve. And that uncertainty about the economic forecast, I think, has gone up. So the modal forecast contained in the summary of economic projections has not changed very much at all. But the distribution, the probability distribution has widened out dramatically, in part because of the banking woes.
Final question, Bill. Next decision is May 3rd. Is that enough time to get the incoming information you think they need?
We'll see. I mean, I think it's going to be either the banking system stabilizes pretty quickly in the next few weeks, or we just have, creeping problems. The problem that in the banking system is when the weakest bank gets into difficulty, that raises the stress on everybody else because everyone else gets more skittish.
Yep.
All the people that are using the banks are much more skittish today than they were before the Silicon Valley Bank failed. And so it doesn't take as much bad news today to generate the same response as a couple weeks ago.
Hey, Bill, this was wonderful, as always. Bill Dudley there, the former New York Fed president, currently, amongst other things, a Bloomberg opinion columnist weighing in on the decision from the Federal Reserve. Lisa, what a moment. Quite clearly, the takeaway for me after that news conference, after that conversation just there, when we talk about being data dependent, what are we really dependent on between now and that next meeting in early May?
How many more banks fail?
It's not CPI, is it?
Whether we get some sense of real credit tightening. Right. It's all backward looking. And right now, the president's moving so quickly. And that was very clear and very present, which is the reason why people seem to still be responding to what Janet Yellen is saying. She's still testifying in front of the Senate. And I do want to just give you a sense of what else she did say. It seemed like she softened her tone just a touch, which is the walk back that some people were expecting. She said, not time yet to say if FDIC insurance cap is appropriate. So, basically hedging and hawing, and you saw a revival in some of the shares of these banks. So right now, people are tracking her comments probably more than any fallout from the Fed. But this, to me, was interesting. She said that deposits left Silicon Valley Bank at a pace that was never seen before. And this comes at a time where there is a new threat and people blame Twitter, people blame media, people blamed everything, but you can withdraw money at the tap of a phone, and that has changed the scenario and the protocol for banks that really rely on these deposits in a way that the larger complex of the banking world does not.
I've always said when these officials testify, they should have a Bloomberg terminal, just a live feed of where markets are when they speak, just to sort of auto-correct them as they're going along.
I think maybe she does,
tick
right?
for tick.
Maybe she was like, all right, walk that
Perhaps,
back.
Maybe. Jeff Rosenberg joins us now from BlackRock. Jeff, I think people are asking the question, was the hike today the final hike?
Well, I think Powell was very clear to try to indicate not only is this not the final hike, but that, to Mike McKee's question, that there's a real disconnect between what the Fed is telling the market in terms of their forecasts and their expectations, and what the market is pricing in terms of cuts at the May meeting, as soon as the May meeting. So I think this meeting, is really about dealing with the present crisis in the banking sector, and that unknown is really, that's going to determine where we are in May. But Powell said something very important about why they changed the statement. They changed the statement. It was much more dovish because of the banking crisis. And then he went on to say why the SEP forecasts were relatively unchanged, and that was due to offsetting factors. The offsetting factors here is that if we didn't have this banking crisis, then this would have been a more hawkish result, and it would have been a terminal rate that probably went higher. He said that explicitly. Our path was probably going to be higher than what we had projected in the December SEP. So going back to what Bill Dudley said, I just want to add that the uncertainty grows on both sides. It's the tail risks that are increasing. And while most people are looking at the market and saying, oh, we're really worried about this banking crisis and the hard landing, uncertainty cuts both ways. And so the other way to think about the uncertainty here is that the Fed didn't do what it otherwise would have done, given the fundamentals of the inflation data that got very little attention at all to the question about 12 times and it's a feature and not a bug. The focus in this meeting is distracted, perhaps rightly so, or perhaps, as we'll see if this crisis fades, that it distracted from the fundamental issue, and that by not having tightened more, they raised the risk on the other side of a more persistent inflation outlook. So I think when we talk about uncertainty going up, which I agree with, it's a two-sided uncertainty.
Jeff, I'm really glad that you brought this up, but I want to build on that. This idea that perhaps people are dramatically underpricing longer-term inflation as a result of not an artificial, but an interrupted rate hiking cycle that would have looked different based on the data. From your vantage point, is that the risk that is most underpriced in markets right now?
I think it is. It's a very asymmetric outcome right now. The market is pricing for the bank scenario. It's pricing for the last 20 or 30 years of Fed policy behavior. Financial sector stress leads to a Fed that pauses and that cuts. That's what we've seen from the Federal Reserve. And if the crisis is big enough, we'll see that again. But that's a big if, and as Powell, stated very clearly, trying to estimate the impact is guesswork. So these numbers that are being thrown around, those are guesses. Is it 25? Is it 150? No one knows. When you look at the market reaction, the 2-year yield chart, and you pull that back a little bit longer, it looks like a lot. For the market's pricing, they're giving a lot of impact to future monetary policy and very soon to be cuts as a result of this event. But the extent, I think was the word he was using, is highly uncertain. And what we also have to talk about not only is the extent, but the marginal impact. Powell talked about financial condition indices, and they mostly don't measure this. And so if you look at bank lending standards, if you look at tightening conditions that incorporate that, you're going to use the survey of lending standards. And that has been showing a tightening condition for a very long time. Certainly, this event marginally increases it, but the question is really to what extent. And if this ends up like UK LDI, then this will be a lot less of an extent, and therefore the market is overpricing the amount of cuts that they should be taking out of the market expectations.
Market to one side, Jeff, I'm with you. It is a guessing game, but I believe the Fed's taken a stab at it. Because if we got an SVP 2 weeks ago, I think that rate, that dot, goes from 5.1 to 5.60. I think most people thought that was what was going to happen. So, Jeff, with that in mind, hasn't the Fed just told us that they think it probably equates to about 50 basis points?
Yeah, I think he even said, one, maybe some more. He was kind of anchoring to 25 or 50, and I think you can infer from the counterfactual on the SEP that is kind of the implicit projection. But it's highly uncertain. And then John, you just asked the question around what are we going to learn between now and then? If this crisis subsides, if the interventions are successful, and think about that, globally, then it will be about the data, and we'll go back to what about the data and the evolution, and are we seeing that disinflationary trend that the market is also expecting to see, or to some of the comments today and what would have been the most recent reflection of inflation data, that you're not seeing that, and that will reemerge as the focus.
Jeff, that's what's going to make the next month or so pretty difficult to trade, because, Jeff, if you think about it, I believe right now this market is likely to ignore the incoming economic data, whether it's inflation or payrolls, and focus on what we hear from the banking sector. So, Jeff, with that in mind, when you talk about those two uncertainties, it sounds like the inflation risk is just going to get parked and maybe built throughout the rest of this summer until we get some clarity on what financial stability really looks like. Now, Jeff, you've got to put money to work against that backdrop, knowing that maybe this market might be less sensitive to incoming information, traditional data points, CPI, payrolls, etc. How would you manage that?
Yeah, you're absolutely right, Jonathan. I mean, the banking sector crisis will happen faster. Its evolution will happen faster than the incoming inflation data. That's good in the sense that, if it stabilizes, it will become stable very clear. We're going to get resolution on some of the other outstanding banks. The global issues seem to be coming resolved. So you can get to that resolution quickly, or you can get to a contagion effect and they need to ramp up, broader intervention policy. That will reconcile relatively quickly. We just don't know in what direction. In the interim, higher uncertainty really means that it's very risky, very tough to make a definitive statement in terms of portfolio positioning. Our stance has been, and it remains, pretty defensive with respect to the hard landing outcomes. And defensive with regards to how much duration risk you want to take here. Given the inversion of the yield curve, you can find some decent yield without taking a lot of duration risk in the front end of the curve.
Just real quick, Jeff, what would it take for you to become less defensive, perhaps a little more aggressive, to feel a little bit more conviction?
Well, I think two things, right? It's about reconciling both of those uncertainties in a positive manner. The first, obviously, being the banking sector crisis and the degree to which it spilled over into too much or over tightening. Effectively, when you look at the bond market pricing in cuts by May, they're saying the Fed's too tight. It's going to have to reconcile that by cutting, and the banking system crisis has accelerated the degree of tightening. I think if you saw that reconciled to the positive sense where there was relief in terms of the hard landing scenario, that's going to reduce the recession risk. And then if you also at the same time start to get back to some positive developments on inflation, you further remove the threat that we were talking and worried about, say, 2 weeks ago, that the Fed had to go longer, faster, narrowing the runway for that soft landing that he got the question for. I think if you see those two developments, then I think it's going to be a much clearer environment for reducing the tail risk of recession and pricing that in. You can start to add some more risk, economic exposure, down in quality credit exposure into the portfolio if you saw those two things happen.
Hey, Jeff, wonderful to catch up with you, sir. As always, Jeff Rosenberg there of BlackRock on the latest Fed decision. I think a lot of people walk away from this thinking Chairman Powell handled that well. History's going to be the ultimate judge. If this financial stability issue gets worse, then the 25 basis point hike looks terrible. If it goes away and inflation stays elevated, it looks like it's the right thing to do. And that's why it's so difficult to be a policymaker confronting decisions like this one today.
What I heard from him was basically, you guys can have your views, I'll have mine. None of us know. We don't anticipate cutting rates. The market says, yeah, you're going to cut rates by almost a percentage point by the beginning of by the end of January. He says, look, you guys do what you want. We'll play it by ear. We've got the backs of banks. It was successful. It was not that interesting. He didn't, which was good.
Stay on the banks going into the close. That's what you need to watch. First Republic down 17%, rolling over. Coming up at the close, Romain Bostic's going to lead the coverage. Morgan Stanley's Seth Carpenter, Ed Yardeni of Yardeni Research. The bank's rolling over. Secretary Yellen weighing in. Chairman Powell goes 25. From New York, this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash. Stocks
are lower across the board. We've got 13 minutes to go ahead of the closing bell. We do check markets all day long at Bloomberg. It is now 3:46 on Wall Street. This update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There is more pandemic relief available to claim for small and medium-sized businesses. The ERC is a refundable payroll tax credit your business may qualify for, even if it already received PPP. Let the tax professionals at Innovation Refunds show you how to get the money your business may be eligible to receive with no upfront costs. Get refunds.com. Stocks are lower after remarks from Treasury Secretary Janet Yellen and Fed Chair Jay Powell.
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings.
Reaction from Jeff Rosenberg, Senior Portfolio Manager at BlackRock.
I think Powell was very clear to try to indicate not only is this not the final hike, but that, to Mike McKee's question, that there's a real disconnect between what the Fed is telling the market in terms of their forecasts and their expectations, and what the market is pricing in terms of cuts at the May meeting, as soon as the May meeting.
Indeed, stocks whipsawed after Powell said that if the economy proceeds as policymakers expect, there will not be a case for rate cuts later this year, as the markets project. The S&P now lower by 31 points, down just about 0.8%. And again, with 12 minutes to go ahead of the close, we've got the Dow down 292, a decline of 0.9%. NASDAQ down 76, a drop right now of 0.6%. The 10-year yield 3.46%, with the 2-year now at 3.94%. Spot gold up at $27 the ounce, gold $19.67 the ounce, up 1.4%. And West Texas Intermediate crude holding above $70 a barrel, up 0.9% at 70.31. Bitcoin now down 4.4%, 26,897 on Bitcoin. Shares of First Republic, they're down 15.5%. Recapping, 10-year at 3.46%, the S&P down 33, down 0.8. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, a very good afternoon, everybody. You are listening and watching Bloomberg Business Week. Carol Masser, along with Damian Sassower, watching the markets, making sense of the Fed decision, and it's been an interesting trade, no doubt about it.
Yeah, no, all right. I mean, we are down across the curve. The 2-year is down below 4% again. I mean, a 23 basis point move on the 2-year, but it's also extending into the belly. I mean, the 5-year is down another 23 bips, so... Yeah, I mean, we're seeing buying of bonds.
Yeah, it's really interesting, right? And you look at the markets, and I feel like the Treasury trade telling you one thing, the equity trade, which rallied initially on that Fed decision, has come undone, and now we're below the levels, and we're seeing losses across the board. So let's get to it with Aaron Kennan, co-founder and chief executive at the registered investment advisory firm Clear Harbor Asset Management. They've got over $1 billion in assets under management. Aaron, back with us on the phone in Stamford, Connecticut. Actually, I think via Zoom. Hey, Aaron, good to have you here. Market reaction. What is it telling you in terms of what we've seen with stock reaction and then the Treasury trade post-Fed decision?
Well, I wouldn't call today a pivot, Carol, but certainly a pause, and I think a justified one. And I say a pause because, yes, they went 25 basis points, but if you look at the SEPs or their dot plot or predictions for future rate moves, they're essentially saying we're on hold here, and we're going to monitor economic conditions. There's some natural tightening occurring in the market due to the banking crisis, due to prior policy prescriptives, i.e. higher rate hikes. And this really is something that I think the market welcomed. And you could see that on the Treasury front, certainly a dovish posture.
Dovish.
As Damian just indicated, rates have moved about 8 to 20 odd basis points across the curve today. Equities are under pressure, and that's because there's a real concern that we've passed sort of the peak growth cycle, and the curve is still inverted. And when the curve is inverted ahead of in a cycle like the one we've been in, which is a tightening cycle, you tend it tends to signal a recession. Yep. And even though the curve is less inverted today, that's often the case just before a recession. And so I don't think that should be a positive signal that we're now at 45 basis points, 2s, 10s, and not 110, which was were just a couple of weeks ago.
Right, yeah, we're not at the depths we once were. But, you mentioned this interest rate vol move, and it's still pretty high. I wonder if you could focus, let's go back to your days at RBC and Citigroup, your days trading IG credit. Talk to me about spreads. What are you taking from the gap wider in spreads and then, the correction we're seeing right now?
Yeah, well, we've gone from, we're sort of past the peak inflationary period, Damien. And I also think we're past, peak tight spread levels. And for the most part, we're seeing spreads trend wider. Frankly, been surprised with the MOVE index as high as it has been for many years, and not really the levels seen since 2008, 2009 financial crisis, which I remember quite well. My view is, as the probability of a recession hits our shores, we will continue to see high yield spreads widen and investment grade spreads widen, but certainly not as much as the high yield sector. So can high yield spreads move back out to 800 basis points over? You bet they can.
So
and I think
I was going to just say, sorry to cut you off, but to me what that means is that, when spreads widen like this, it means that borrowers are reassessing the external funding environment, right? So does that mean that as investors we should be placing greater emphasis on, coverage ratios, repayment risk, and the like?
Absolutely. You look at the regional bank outflow of deposits, and what does that really mean? That means lending standards are tightening. That means there's less credit availability. When that happens, it tends to be by about a delay of 2 or 3 quarters, prelude to a recessionary period. Higher rates have huge consequences for public funding, but of course, you just alluded to, the commercial real estate market. We have almost $1 trillion of commercial real estate debt coming due within the next 12 months that needs to be, repriced. Repriced where? At higher levels and higher spreads, wider spreads.
Well, and I have to say that if you take a look towards the end of that press conference, Jay Powell specifically talked about financial conditions tighter than indexes indicated, and talked about how many of the indexes that we all talk about are all about the equity trade, and that he said in terms of talking to banks and so on and so forth, you're seeing those tighter conditions. He also mentioned commercial real estate. Is that potentially, Aaron, we all talk about it a lot here at Bloomberg, and I don't want to be kind of alarmist, if you will, but we are kind of wondering, coming off the pandemic, ultimately with commercial real estate being used differently, vacant, if you will, is that the next big shoe to drop in the financial community?
Well, it was interesting today. During the Q&A, Chairman Powell sort of put a rather rosy picture on commercial real estate and the risks that it may pose to the economy. And I understand why. He's the Fed chair, and cracks do not appear, at least in the public domain yet. But we look at the vacancy rates. Of course, the most magnified issue is probably still in New York. But I think, there's, and not all commercial real estate is created equal. You have office, you have distribution segments, you have multifamily, which still is reasonably strong.
You guys left New York, right? You left New York during the pandemic. Forgive me, but go ahead.
we did. And we're here in Connecticut and Fairfield County, and we still make our way in New York. We still have our many meetings in New York, but, certainly big fan of New York, wanted to thrive.
Right.
But certainly the current concern, as it should be, for real estate exists in the marketplace due to higher rates, wider spreads, and tighter lending standards. Not to mention, too, the consumer out there is experiencing tighter, spreads. You look at your credit card. If you pay it off every month, that's great. But if you look below where the amount is, it tells you you're probably going to be charged an APR rate of 20%. And the problem with that is the revolving lines of credit are increasing. People are more leveraged at the household level over the last several quarters. And you look at the household savings rate, and it has a 2% handle, which is below any sort of historic norm. So, we're certainly aligning for a period of uncertainty. And I think the Fed was very justified in signaling verbally and in their written statement. And that was a nice thing to see, too. Their written statement and the Q&A was a little more consistent this time.
Totally.
Yeah. No, I mean, Aaron, I just have one really good question. You mentioned that $1 trillion of commercial real estate loans that are supposed to be maturing between now and the end of next year. That seems to be a huge maturity wall. I mean, what are your thoughts on cap rates? I mean, what are your thoughts if, banks can't extend and there's no equity cushion available? I mean, sponsors that own the property are going to have to come up with that additional equity, no? I mean, are they capable of doing that?
Well, we'll have to see, Damien. I think is the short answer. Cap rates certainly are a problem, but you're going to have adjustments in price, and so the question is by how much. And I think the leverage ratio is the big question. Loan to value on a refinance. Yes.
Aaron, sorry. I mean, we had a million questions for you. We're running out of time. So 20 seconds left here. So what are you doing differently with your investors' portfolio right now, just quickly?
Well, in a stormy period, we hope and we do ensure that our clients' asset allocations are not just reflective of their risk tolerance during the rosiest periods of the economy, but also during these more uncertain moments. Do they have sufficient liquidity? Are we positioning them for that and for the long-term needs that they have? And so I'm gratified that we try to do that work beforehand. We don't always get it perfectly right, but we've done it quite well here, and really proud of the team.
Aaron Kennan of Clear Harbor Asset Management, thank you so much. All right, everybody, we're going to head over to our TV colleagues. Damien and I, we're getting ready for Beyond the Bell.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to those closing bells. Here to help take us beyond the bell, it's a global simulcast. Carol Master joining us right now alongside Damian Sassower. Welcome to our audiences across all of our Bloomberg properties, television, radio originals, and streaming on YouTube. Carol Master, the rate hike, not necessarily a surprise.
No.
The maintenance of QT, not necessarily a surprise. But some of the commentary by Powell and that overlap with the commentary by Yellen on the banking sector certainly causing some agita for the market.
I got to say, we're just coming off that Fed decision. I've been glued to the markets, but I've been glued, as you say, Romaine, to those bank stocks. I'm looking at the KBW Bank Index. It's down 4.6%. If you look at the regionals, the KRE, it is also down. The Spider S&P Regional Banking, it's down 5.6%. Janet Yellen coming out and basically saying we're not considering insuring all uninsured bank deposits. To me, Damien, they're kind of dialing back a little bit that backstop we all expected.
Yeah, no, I mean, look, all this talk about bonds and stocks, forget about it. For me, all the actions in the FX market, look, whatever happened to the U.S. dollar smile? The dollar is not rallying in the face of all this volatility, specifically on the interest rate side. It's been up 9 out of the last 10 sessions. It's up 5 sessions in a row. Down 9 of the last 10 sessions, down 5 sessions in a row. The dollar is getting weaker.
I get that confused, too.
Sorry about that.
Hey, it's been a lot today.
It's been a long day for me.
On your point, though, too, I mean, we talk about this idea of sort of what we saw out of the commentary by Yellen. And I think it's interesting, too, because there was also conflicting commentary by the chairman of the banking committee who seemed to suggest that there could be some sort of blanket protection, at least something that he would want to see. All right, guys, we are getting the closing bells here in New York City. It is a down day, and it is a pretty big reversal from where we were just a couple of hours ago, where the NASDAQ had actually rallied about 20% off of its cycle low, but now going to end the day down by about 1.6%, down about 190 points on the NASDAQ composite right now. The S&P 500 lower by 66 points or 1.7%. The Dow Jones Industrial Average lower by more than 500 points or about 1.6%. And, of course, we have to talk about the bank stocks. The Russell 2000 lower on the day by 2.8%. We know, of course, a heavy weighting there in that space among financials and small and mid-cap banks, Carol.
It's fascinating. The NASDAQ 100, wasn't it at one point a big bump up from the low, I think 20% from that December 28th low? So it's interesting that we had a headline like that talking about, maybe another bull market, if you will, or, a correction off of that low. And yet here we are looking at the overall equity trade. I feel like there's a lot of nervousness there, Damien.
Yeah, no, and I mean, for me, it's all about the fact that we basically are seeing all that strength in the fixed income market going out into the belly of the curve. It's really the 5-year, the 7-year. I mean, we're down 23 basis points across the curve pretty much, and it is something to take note of for me.
I want to talk about the bond market, but let's talk about some of the industry groups because it is red across the board, all 24 closing in negative territory. Semis almost made it into the green, not so much though, closing a hair lower. Then you also have household products. You have tech up there as well. Staples down nearly 1%. Then you go all the way to the bottom. It's what we've been talking about. It's the banks taking it on the chin, down 3.5%, Carol, after Treasury Secretary Yellen said that they're not considering a broad increase in deposit insurance. Really took some of the momentum out of this market.
Yeah, Debbie Downer.
Yeah.
Oh, go ahead.
Just real quickly, I just want to
Yeah,
point out just the
please.
swings from, because this flip-flop that we had, I think really needs to be pointed out here. 100-point swing on the S&P 500 from peak to trough today. This is going to make this one of the most volatile days, Carol, that we've had all year.
Yeah, absolutely. I think, especially when you have Janet Yellen come out and make those comments after we had what some say, we just had Aaron Kennan on, say that Jay Powell did a good job in terms of the decision, the statement, and the press conference kind of all aligning, if you will, in terms of the message. But you definitely are seeing some confusion play out here in the trade and that volatility marking it. All right, so let's get to some of the individual gainers in today's session. NVIDIA definitely a standout throughout the day, topping the S&P 500 and the NASDAQ 100. This stock has been on quite a run, up 8 days in a row, up roughly about 19% or so, but finishing the day with about a 1% gain. The semiconductor company introduced new chips yesterday, supercomputing services during its annual developer conference. They talked about AI. You had a slew of analysts coming out and raising their price target on that. So that's why you saw certainly that one getting a bump to the upside. GameStop. We talked about it after the close yesterday. Certainly, again, we can debate the fundamentals forever, but nonetheless, a standout in terms of gains today, up about 35% at the close. The company did report a surprise profit in the fourth quarter. Big float, though, still, in terms of the short position. 22% of that float is shorted still. Carvana also up about 6% here, was up as much as 14%. Company offering to exchange up to $1 billion of bond principal at below par prices as it works out plans to kind of restructure its debt load. So,
and this is going to be the big issue for these types of companies that have to find a way to restructure debt or not. And how do you do that in this environment?
We just talked with Aaron Kennan about $1 trillion, of commercial debt that's
commercial
out
real
there.
estate, commercial real estate loans that are coming due within the next year, they're maturing within the next year. Well, look, for me, I mean, if you want to talk about equities and me being a Debbie Downer, I have to look at Petco Health and Wellness. Ticker symbol WOOF, down 15% today, 10% on the year. I think management is forecasting another 5 to 6 quarters of weakness in discretionary items, weak revenue growth, second straight decline in annual profit. And then it's Nike, down 2.7% today, still up on the year despite reporting better than expected quarterly sales and boosting its top line outlook. It missed estimates on profitability because of higher input and freight costs. And finally, for you, Katie, Coinbase, down 4.1% today. It's up 130% on the year nearly after rising 7 consecutive sessions in the crypto exchange's best move ever. And BitDog failed to hold above the 28,000 threshold, and the 7-day rally of 57% is now over. So that's it for Coinbase. That's it for me.
And more volatility, of course, in the Treasury market. Once again, here you take a look at where the yields stand right now. We saw these big moves, and I think that's interesting. You talk about 23 basis points down on the 2-year yield. Similar story for the 5-year yield, even the longer end of the curve. You're down about 17 basis points out when you go out to that 10 and further out. The question, though, that I have here isn't so much about the level of yields, but about the volatility. 10 straight days now, we've had a move of 10 basis points or more, and on 8 of those days, it's been over 20 basis points, at least with regards to the 2-year and that shorter end of the curve. That's not something that's supposed to happen. So when you hear Jay Powell talk about price stability, I know what he's really talking about. But for the market, this is price instability, and it's scary.
You're speaking my language, Romaine. I mean, we're talking about what's supposed to be the ballast of your portfolio. To see this type of volatility, it just really speaks to how much uncertainty this is. And it raises a broader question of what is liquidity like in the Treasury market right now. We know that's been a concern for well over a year. Janet Yellen has spoken about it.
Is there liquidity in the credit market? Because last time I looked at a chart, it was fading.
Exactly.
And it faded a while ago.
I think Katie's talking about the Treasury market, Romaine. I mean, the $20 trillion beast where money markets have not kept pace over the last dozen years. So this is a much bigger market without a lot of buyers.
Yeah, so the volatility is certainly unusual, right? This is not something we expect from the Treasury trade, and that is certainly a new thing that's facing investors, and you do wonder how that just kind of unnerves them, and then you do wonder where do they go ultimately, Katie, if they're looking for some place to park some money in this environment.
It seems like the easy answer, the asset class that's been working, again, for well over a year, is cash. But on the point of the Treasury yield, talking about volatility, talking about liquidity, at 12 p.m., the 2-year Treasury yield was completely unchanged, only about a basis point higher. It was beautiful. That was the smallest move since March 8th, which was the day before what I'll call the banking crisis. But obviously, we've now broken that and broke decisively lower.
We've broken decisively lower here, and now it really gets to the question here of what's next. This really isn't about the Fed anymore. This isn't really about rates anymore. This is much more in the lap, I think, of the Treasury Secretary and maybe even the White House and, dare I say, Congress. But, you know, Lord knows we don't want to put anything in their laps.
Well, Romaine, you asked it. What comes next? I'll tell you what comes next. The Bank of England comes next. We got a rate decision tomorrow. We've got the Swiss National Bank tomorrow. They're going to, I think they're going to hike as much as 50 basis points. And then we've got the Philippine Central Bank overnight as well. They're expected to hike another 25. But it's kind of a dovish hike, Romaine, because the last one was 50. So that might get you feeling better.
Yeah, inflation's still a problem, no doubt about it. We know that. We heard that from Jay Powell, and global central bank's going to do that. But I have to say, on my radar is going to be what's happening to banks next. How does this story continue to go on? Is there more, you know, failures, if you will, more problems at this point? And I think that's what's really unnerving everything right now.
I was looking at that PacWest deal a little bit earlier. Remember, First Republic still hasn't been resolved. And there are other banks out there, we know, that have also sort of raised their hands and say, hey, what about us? And at some point, this has to be resolved. If they think that they want to let the private market sort of handle this, which does seem to be what they want to happen, the question is, can we withstand that? As a broader economy, can we withstand that?
I thought it was interesting what Jay Powell said basically about Silicon Valley Bank and their management, that, listen, the central bank, Katie, right, has been telegraphing forever that they were going to raise rates if you go back a year. So that bank management, risk managers didn't catch this. And then you do wonder, all right, who else didn't do it?
To be fair, the supervisors didn't catch it either. And Powell did make multiple reference to the fact that it had been on their radar.
I'm confused. Is the San Francisco Fed not part of the Federal Reserve?
Well, I was going to say, they certainly put out, they said that there were problems, there were issues, but where was the follow through?
Well, I mean, I say there's problems all the time. I don't follow through. Just ask my wife.
Well, I mean, that's definitely one of the tasks forward for the Fed is how do they tighten those supervision roles that they have and actually catch something like this before it happens, even though they were aware of it.
Hey, P.S., Jay Powell's all for some more bank regulation. Did you get that out of the press conference?
Big time.
I did that. Yeah, big time.
Big time. All right, guys, more to come certainly tomorrow. We'll see how the market follow through goes into the Thursday trade. All right, that is a wrap. Our cross-platform coverage, radio, TV, Bloomberg Originals, and of course on YouTube, Beyond the Bell. We will see you again, same time, same place tomorrow. All right, I'm going to say I'm so glad that we're doing this segment next because I feel like coming off that discussion, it's all about banks and what happens next. So let's get to it because we did have some headlines. Let's get to our Bloomberg News finance reporter, Sri Natarajan. He's here in our interactive broker studio along with Herman Chan, senior analyst for U.S. regional banks at our Bloomberg intelligence team, because we did have PacWest shoring up its liquidity, First Republic again under pressure, and then you had Janet Yellen. Wah, wah, wah. Sri, let me start with you. What are the headlines as you look at this situation that you think we need to be sharing with our audience?
Look, as I walked over to the radio booth, you could see the markets taking a nosedive into the close. But that's not all. When you look at someone like First Republic going down 16%, that's a stock that's been beaten up this month, down 90%. This was a 3-digit stock not that long ago. At the start of the month, this was around $130.
Why aren't things coming down for this one with all the assistance it's gotten so far?
Well, the question is that enough? And we have a very good story on Bloomberg right now, if you read it, which gives you a very good explainer as to why there is such reluctance in any sort of white knight coming forward. There is a big gaping hole in that balance sheet. They break it down. Their securities portfolio has taken a $4 billion hit. Their loan book, and this is a bank, First Republic, that has a big presence in the real estate market, is a big player in sort of that jumbo mortgage loans. Think about the dynamic there. They must have made so many major loans with 2%, 3% fixed rate long-term mortgages that have obviously taken a hit. So you have a situation where there's this $26.5 billion hole, and tangible common equity is probably worth $13 billion. So there is still the hole that needs to be filled. So it's not quite easy for anyone to come in without possibly some sort of government backing. We've talked about that idea. We believe that is at least being studied, but is a solution on the horizon, that's unclear to us. And at 3 p.m. in the middle of a market day, in the middle of the Treasury Secretary speaking to the Senate, in the middle of a Jay Powell press conference, when the bank has to put out a filing that says their top executives, the CEO, the chairman, and a few other executive officers are going to zero their bonus for the year, are going to take a salary cut, that doesn't really instill a lot of confidence, does it?
Yeah, Sri, look, I mean, SVB Signature, First Republic, PacWest, Herman, feel free to jump in here. There are 50 banks in the KBW Regional Banking Index, from Bank of Hawaii, which is down 30% this year. That's, by the way, a few hours, I think I ran that 30 minutes ago, to New York Community Bank Corp, which is up like 10% on the year. Which other banks seem most vulnerable to you?
That's a risky question to answer, and in fact, I would probably sort of try and get at that by looking at what has happened to the stock. So, what are equity investors seemingly most concerned about? And some of the names that we flagged are names like PacWest and Western Alliance and
Bank of Hawaii.
PacWest, at least some good news this morning. They put out a detailed press release, which at least indicated that they have shored up liquidity measures. They've got help from Atlas SP. Fun fact, backed and owned by Apollo, which recently bought the securitized products group from Credit Suisse, rest in peace, and spun it off as the standalone investment firm that is now stepping in here to be a little bit of a rescue entity for PacWest, if you may. They're not doing any other capital raise, but for now they have more cash than uninsured deposits, and that's good news.
Herman, come on in.
A PacWest issue. The big deposit outflow was in the venture banking business, which is what SVB does, what Silicon Valley Bank does. So when PacWest had venture banking deposits down 43%, it just shows that the herd mentality of the VC community affected SVB is affecting PacWest. And we also did a read across in our research today, looking at Western Alliance, which also has some technology-related deposits. It's only 14% of the total deposit base, which should insulate them going forward if we do see a similar deposit outflow from the technology clients.
So how are you guys? I mean, it's interesting because we were also just talking about kind of real estate exposure too, and then you wonder, what that implications will be. So what do we need to be thinking about? That should we expect there's going to be more problems, Shri? I mean, I don't know. What are you hearing from your sources?
Look, the Fed chair was out there talking about the fact that there are some small banks that they are concerned about. At this point, everyone is focused on First Republic because, as the term they all likely use, is it's a real bank, and the reason they say that is it's not a small entity. It had about $175 billion in deposits at the end of the year, right? So it's a reasonably sized bank. It's clearly going through a lot of problems. Not just that, but it also had this consortium of 11 of the country's biggest banks coming forward and trying to provide it aid. That might just have been
it's like
window
the
dressing.
ultimate financial hug, if you will.
Yeah. It is the ultimate financial hug, but did it really mean a lot is the question?
Very heavy, though. It's
Right.
only
Exactly.
$30 billion when
Not
we estimate the hole in their deposit outflow was $89 billion. So it gives them a short-term bridge to a longer-term solution, which we're still waiting to hear what that is.
Janet Yellen's comments, though, took out the banking sector again today. So did she make a mistake? Why did she do that? She had to know that there might be that impact.
She spoke recently at the American Bankers Conference on Tuesday and said that if there were a smaller institution that would fail, the regulators would step in and guarantee the deposit. So the market was working under the assumption that that was the case. But then she came out today near the market close and said there's no blanket guarantee. So those two concepts aren't directly opposed to each other, but it just doesn't instill a lot of confidence within the broader market.
I will point out that it is a comment that was made in Washington, D.C. It is a comment that was made in front of a lot of politicians. And in that city, every single word matters. And there is careful word choice going on there. Blanket for once. I am not considering for others, because we have reported that her staff is actually considering measures on how they could perhaps have a temporary increase in deposits. They've certainly given it thought. Considering it, not considering a blanket increase in deposit guarantee could well mean that nothing's imminent. We're not planning to do that, but are they scenario planning? Perhaps.
So you mentioned Washington, D.C. Herman, you mentioned Apollo. I have to ask this. Apollo's rescue of PacWest comes on the heels of the UBS acquisition of CS. My question is this. You got talk now of Warren Buffett trying to get back involved with some of these bailouts, right? I mean, if you remember the GFC, I mean, he was involved with Goldman Sachs and made a killing. how do you think these deals are going to work out for people like UBS, for some of these other banks out there that are the acquirer? I mean, to me, it seems like things are setting up pretty nicely.
Yeah, I would say that the UBS Credit Suisse deal was a bit different than what Apollo's doing. Apollo's doing
Free
an
lunch?
asset-backed deal where if things go bad, they at least own the deposits and can monetize. So their risk is much lower versus taking an equity stake in a regional bank that is feeling some pressure. So that there are going to be other types of deals like what Apollo's doing, but they're not putting equity skin in the game at this point.
No surprise, First Republic cut to B from double B by Fitch, maybe cut further. No surprise. Shri, if First Republic can figure something out and there is something done, does it start to calm down?
Yes, because if the current thinking across the spectrum is there is no obvious solution, there is no easy solution, and suddenly tomorrow morning you come and tell me that they have found out a solution, that should help. Even with
the broader sector.
Yes, because this has been sparked by a crisis of confidence, not sort of any obvious. Irresponsible risk-taking to the hilt, right? Like these people are talking about hits to the securities portfolio, which is not because they invested in the riskiest stuff out there, but
can
stuff
the
that
system
you would.
afford to let First Republic fall? Real quick.
Hard to say, but the obvious answer I would have to assume is no. They would, because then if you have to find a whack-a-mole solution, it then becomes a whack-a-mole literally, because then then another FDIC has to step in. Then every investors then go and see which other bank would be most pressure. Then you go from one to one to one to one to the next, and that's not a fun game to play.
I wish we had half an hour more. But folks, that's what you needed to know when it comes to banks. That's where we are, 4:17 p.m. Wall Street time. Shri, Herman, thank you so much.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
A stock sell-off on Wall Street, 421. The time right now on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. Lots going on after ours. We begin with earnings out of KBH, KB Home. It narrowed its housing revenue forecast for the full year. KB Home's first quarter deliveries topped estimates. Shares after ours up by just about 3.3%. Chewy, the pet food retailer, reported net sales for the fourth quarter that beat the average analyst estimate, but after ours, that stock is now lower by 2.3%. The Dow, the S&P, NASDAQ all closed at session lows today. Stocks were treated as comments from Treasury Secretary Janet Yellen rattled bank stocks, and Jay Powell dashed hopes that the Federal Reserve would cut rates this year. You heard Powell's remarks live right here on Bloomberg Radio. S&P ended the day down 65 points. A drop there of 1.6%. Dow Jones Industrial Average down 530, down 1.6%. NASDAQ down 190, also a drop of 1.6%. 10-year yield now 3.44%, with the 2-year 3.95%. Spot gold up 1.5%, $19.68 the ounce. West Texas Intermediate crude up 0.5%, $69.99 a barrel. Some of the other stories that we are following for you after ours right here on Bloomberg Radio. We were watching GameStop shares today, and they soared after reporting a surprise profit in the fourth quarter. Today, GameStop is up by 35.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Damian Sassower of Bloomberg here in our Interactive Broker studio, streaming on YouTube and on Bloomberg Originals. So by one measure, doing a little bit of research ahead of this segment, the global cloud communication platform market likely to reach more than $51 billion by 2030, compound annual growth rate of nearly 20%. So one player in that market is the cloud-based communications provider. You know the name, Vonage. They are owned by Ericsson. And with us here in our Bloomberg Interactive Broker studio, Rory Reed. He is the CEO of Vonage. He's also Senior VP at Ericsson. Welcome, welcome. Nice to have you here with Damian and myself here in our studio. How are you, and how do you feel the business environment is amid what we're seeing continued volatility in parts of the financial markets?
Well, I'm great. So first of all, thank you for having me here in New York at the beginning of spring.
Nice.
And I suppose, in the macro level, it's going to be choppy. There's no question. And the volatility is
But
going
there's
to continue.
choppy, there's financial crisis choppy, there's choppy like, we're not quite sure choppy.
I'm, 3-4 decades in the tech space. I've seen all these cycles before.
Yeah.
One thing is the market's going to turn, particularly in tech, and when it does, it turns hard and it turns well. It's going to be choppy for a few more quarters, whatever it is. But in the meantime, what we have to do is focus on cash flow management, make sure you're managing your cash, invest where you can in market dislocations and M&A, and in your product. Get differentiation right now because the market's there. The long-term tech trend is intact, and the opportunities are right now to take advantage.
Roy, North America is Vonage's core market, right? I wonder if you could just help me understand what scares you more, the thought of a recession or persistently higher inflation?
From a standpoint of the business, our business is actually a third across the globe. I think from a business perspective, inflation has a long-term negative impact on everything. It's just not good. You have to clean it up. A recession is temporary. It doesn't usually last a long time. I'm hopeful that we can move through this period of volatility. And what you're going to see with Ericsson's support, we're in a very unique position. Many of our competitors won't make it through this issue. We've got the support of a company like Ericsson. We can double down. We can build in the better products that differentiate.
Why won't they make it through?
Well, many in the tech space have lived off of cheap money for a long time. So they've been very speculative.
So this big move in rates over the past year
hurts them.